Hi guys, welcome to BCCA. This is Ravi, Teja, and I'm your faculty for corporate financial reporting and direct taxes at CMA inter levels. The thing is pretty simple. First of all, sorry for the delay, guys. I know many of you are waiting for the marathon of capital gains, but yes, I was occupied with a little work of my other subjects. I'm constantly having a marathon also, which will be starting from tomorrow onwards. I mean, day after tomorrow onwards. So I have been a little bit occupied, but still I have managed to record the best version of capital gains come marathon, which most of you students are requesting. This is the most awaited marathon. I think it is around 2.5 hours. So 2 hours 30 minutes it will be completed. Best marathon will be provided. What you have to do is aram se watch this marathon at 1.5 or 2x ka speed. 1.5 to 2x you can watch. Once you have get proper comfort, then you can watch it 2x also, no problem. But the thing is, you have to solve questions. Whatever the topic which I have completed, आराम से just have to solve questions. Whatever the workbook you are having, you can आराम से check that questions. ठीक है? I will be attaching the PDF in the description. So आराम से check this. And please do mention in the comments if you are finding this marathons useful. I recommend you to like this video, share to all your fellow CMAs or even CAs also who need proper clarity with respect to the subject direct taxes. Okay? Because if you do like that, that will be acting as motivation for me. And I will be coming up more and more and more videos which are really helpful to you. I think the point is pretty clear. Yes, sir. And one more thing, what is the next chapter which you are waiting for? My marathon. So please do comment. So that's it. I will be coming up with the next video as per your request. So thank you so much and watch the video till the end. Hi guys, this is Ravi Teja. I am your faculty for direct taxes at CMA and CA inter levels. So we have already started with chapter wise marathons and I have already released income from salaries related marathon. So now most of the students are requesting for this capital gains marathon. So now let me decided that let me give you a crystal clear marathon with respect to the chapter capital gains. After watching this marathon, whatever the question which they are going to ask in your exam, you are getting a total proper comfort over there. Okay? Yes, sir. So we have to understand the first thing is nothing but the charging section in this capital gains chapter. Very, very simple, Sati. First of all, they will be highlighting two things. Sir, first thing, though, capital asset should be there. Second thing, though, it should be transferred. Sir, if any capital asset is transferred, na, then only if any profit or gain is arising, that profit or gain is taxable in the previous year in which the transfer have taken place. If you carefully analyze the capital gains ka charging section, sir, first thing though I have to understand capital asset should be there. Sir, next thing though it should be transferred. Sir, third thing though it is taxable in the year of transfer. So these three things we have to understand. That's it, guys. Simple sa capital gains chapter. This much only you have to understand. Okay, sir. But some exceptions are there. Sir, what we will do in those exceptions? In those exceptions, taxability year is not the year of transfer. Taxability year is not the year of transfer. Okay, we will cover those exceptions a little later. But first, let us start with very basic thing onwards, which is nothing but capital asset cut definition we will try to understand. Sir, capital asset definition is given in section 2 clause 14 of Income Tax Act. There they will say capital asset means all assets, either any kind of property, whether or not connected with business or profession, which means that sir, one building is there that is my personal property. It is also a capital asset. Sir, one building is there that is related to my business. That is also a capital asset. That is also a capital asset. Whether it is personal or business oriented or tangible, intangible, movable, immovable, everything is classified as capital asset. For the purpose of income tax, it is very clear. Whatever the asset which you are having, whatever the property which is held by the SSA, that is called as capital asset. Okay, sir. Second thing though, sir, if any securities is held by FII, sir, FII means foreign institutional investors. If any foreign institutional investor is having, for example, equity shares or debentures or bonds in India, that will be always treated as capital asset. More about FII, you will understand at your CMA final level. So at inter point of view, generally they will not ask any question. But even if they ask, just remember, sir, any securities held by FII will always be called as capital assets. Third point though, sir, if any ULIP is there, if ULIP is issued on or after 1st of February 2021, to which exemption under section 10 clause 10D is not applicable. Taxability of ULIP is generally discussed in section 45 subsection 1B. But this section 45 subsection 1B also is not that much important for your syllabus. You can aram say ignore that section. But some discussion with respect to this ULIP I will be making in income from other sources ka chapter. There we will have a discussion with respect to life insurance policy. It includes ULIP ka discussion also. There I will cover that life insurance policy ka discussion. But just remember, if any policy is exempted, it is not a capital asset. If any policy is exempted, if any ULIP is exempted, it is not a capital asset. Sir, but if exemption is not applicable, which means it have to be taxable. If exemption is not applicable, it have to be taxable. Sir, under which head it is taxable? Under capital gains, it is taxable. Sir, how you are saying it is taxable under capital gain? Because they have included such ULIP for which exemption is not applicable in the definition of capital asset. Therefore, it is exempted. Sorry, therefore, it is taxable under capital gain because it is a capital asset. To conclude, it is very simple. Sir, capital asset means all kinds of property. Second point, I mean, whether it is tangible, intangible, movable, personal, immobile, everything is called as a capital asset. As simple as that. Second thing, to any securities held by FII. Third thing, to any ULIP to which exemption is not applicable, which is issued on or after 1st February 2021. Before that, it is exempted. Therefore, you have to remember this date. But fine, this ULIP taxation also is not there. I mean, it is there, but not that much important at CMA inter level. We will be discussing that section 45 subsection 1B at final level. You will understand. Okay? Yes, sir. But most important, sir, some items are excluded from the definition of capital asset. Sir, what are those items? Let us try to understand. Sir, first one, the stock in trade is excluded. Reason is very simple. Sir, I am an entity. I am having some stock in trade. Sir, obviously that stock in trade is also my asset. As per the definition of a capital asset, it is also, I mean, as per the definition of a capital asset, it is also a kind of property. Correct? Stock is also a property. It is also an asset. But the thing is, sir, if I am having any stock in trade, if I sell that stock in trade, which is nothing but I am selling my business stock, therefore income is taxable under PGBP. Therefore, they have clarified, sir, stock in trade is not my capital asset. Therefore, if I sell any stock in trade, that is taxable under PGBP but not capital gain. Because don't forget the charging section. Capital asset should be there. If it is not a capital asset, straight away out of the chapter of capital gains. You don't need to compute the capital gains at all. Understanding or not? Yes, sir. Sir, second thing though, personal movable property. Understand, guys. There are some properties. అంటే కొన్ని ప్రాపర్టీస్ని మనం సేల్ చేస్తే మనకి లాసెస్ వచ్చే సిచ్యువేషన్స్ ఎక్కువ ఉంటాయి. ఫర్ ఎగ్జాంపుల్, ఫర్నిచర్, కార్స్, సైకిల్, wearing apparels, etc. These are personal items and movable items also. What the department is saying is, if I include these items as capital assets, you will always get losses. If you get losses, you will use those losses. You will use those losses to reduce your other incomes. Therefore, department is saying, oh, we are more clever than you. Therefore, these assets now we will exclude from the definition of capital assets. If these are excluded, for example, in case if you get profit, don't pay any capital gain. Sir, but profit though will not come only. Okay, but even if you get losses, no tax treatment because it is not a capital asset. If it is a capital asset, then only I will compute capital gain. If I compute capital gain, then there may be a chance that I may get capital loss. Then it is fine. You can set off that loss. But here though, since these are excluded from the definition of capital asset, for personal movable property, if I transfer, no capital gain if I got any profit, no capital loss set off is also not allowed even if I get loss also. Reason is simple. డిపార్ట్మెంట్ ఏం చెప్తుందంటే ఈ ఐటమ్స్ని మనం సేల్ చేస్తే మనకు ఆల్రెడీ లాసెస్ వస్తాయి. ఒకవేళ వాడు గనక ఈ ఐటమ్స్ని క్యాపిటల్ అసెట్స్ కింద ట్రీట్ చేశాడు అనుకోండి, మనం ఏం చేస్తాం? ఇఫ్ వి సెల్ వి విల్ ఆల్వేస్ గెట్ లాసెస్. సార్ లాసెస్ వస్తే ఏమవుతుంది? మన అదర్ ఇన్కమ్స్ తగ్గుతాయి. అదర్ ఇన్కమ్స్ తగ్గితే మన ట్యాక్స్ లయబిలిటీ తగ్గుతుంది. అందుకే డిపార్ట్మెంట్ వాడు ఏం చేస్తాడు, ఓ వీఆర్ మోర్ క్లెవర్ దాన్ యూ, అసలు ఇవి క్యాపిటల్ అసెట్స్ కింద తీస్తాడు అనుకోండి, ప్రాఫిట్ వస్తే క్యాపిటల్ గెయిన్ పే చేయం, లాస్ వస్తే సెట్ ఆఫ్ కూడా చేయకూడదు. యాజ్ సింపుల్ యాజ్ దట్. But again, some items, those are personal items as well as movable items. Sir, gold jewelry, that is my personal and movable. But sir, gold prices increases. Department is saying, oh, personal movable property is excluded from the definition of capital asset. But department also knows if I sell gold, obviously I will be getting some profits. Similarly, like this jewelry, other 5 items are there. If you sell these 5 items, yes, those are personal, yes, those are movable. But those 5 items, I mean, including jewelry, total 6 items will give you profits. Oh, department is clever. For these 6 items, they have excluded from the definition of personal movable property. Sir, exclusion of an exclusion is an inclusion. Oh, we have learned something new. Exclusion of an exclusion is an inclusion. Correct? Because enemy of an enemy is your friend. Enemy of an enemy is your friend. So same logic. Sir, what are those 6 items? Please tell me. Jewelry, drawings, paintings, sculptures, archaeological collections, any other work of art. Sir, these 6 items are excluded from the definition of personal mobile property, which means these 6 items are capital assets. Sir, if I sell these 6 items, if I get profit, do I have to pay capital gain? 100% yes, because it is a capital asset. Sir, if I got loss, can I set off? Yes, because it is a capital asset. I hope the point is clear. Sir, normally personal mobile property is excluded, but department knows, sir, for 6 items I will get profits. Oh, okay, so include those 6 items as capital assets. If those 6 items are capital assets, if I sell them, if I got profits, I have to pay capital gain. Sir, but if I got losses, I have to set off those losses. Aram I can do that. Second exclusion is also done. So third exclusion to rural agricultural land. Understand very simple. Sir, first of all, they are saying only agricultural land. That too, it should be located in rural area. As simple as that. Sir, the meaning of rural agricultural land is very simple. They have defined which is not urban agricultural land. But some other people will say, sir, what is the meaning of urban agricultural land? Then you cannot say that, sir, something which is not rural is urban. You cannot say that now. Therefore, they have defined the meaning of urban agricultural land. Sir, what is the urban agricultural land? Based on population, we have to understand. Sir, if any particular area population is more than 10,000 but up to 1 lakh, whatever the land, I mean, whatever the area which is present in, I mean, whatever the land which is present in that area, that is called as urban. Not only that, its surrounding 2 kilometers is also treated as urban area. For example, for example, sir, assume this is the land. Sir, here the population is 50,000. Sir, it is more than 10,000, but up to 1 lakh, yes. So, if my agriculture land is located in any of this area, sir, obviously it is an urban agricultural land. Sir, not only this, its surrounding 2 kilometers is also treated as urban agricultural land. Similarly, sir, if my population is more than 1 lakh, but up to 10 lakhs now, that land is called as, I mean, that area is called as urban. Surrounding 6 kilometers is also treated as urban area. Sir, if the population is more than 10, that area is anyways called as urban. Surrounding 8 kilometers is also treated as urban area. But whatever the land which is not urban is called as rural. Sir, only rural agricultural land is not a capital asset. Which means, think and tell me, sir, if I sell any rural agricultural land, do I have to pay capital gain? 100% no, because it is not a capital asset. I hope the point is clear. Yes, sir, the point is clear. Now comes the next part, guys. Super duper bumper important. I will be only focusing on relevant things. So if I ignore something, just uh, conclude that it is not that much important from exam point of view. Okay? Next, sir. Types of capital assets. Sir, first of all, we are having two types of capital assets. Sir, first type of capital asset to short-term capital assets. Second type of capital assets to long-term capital assets. First type short-term, second type long-term. Sir, why these two types? First of all, based on what I can say that an asset is short-term or long-term? Very simple. You have to find out something which is called as period of holding. What I have to find out? I have to find out something which is called as period of holding. This period of holding is nothing but it should be counted from the date of purchase till the date of transfer. For example, sir, I have purchased one asset on 1st April 23 and I have sold the same asset on 31st March 26. This period is simply called as period of holding from the date of purchase till the date of transfer. That's it. Based on this, an asset will be categorized as whether it is a short term or a long term. Sir, first of all, we are having two categories. Earlier, if you have taken my earlier classes, three categories of assets are there. Category A 12 months, category B 24 months, category C 36 months. Sir, but you have written here only two categories, which means is this wrong? It is amended, guys. It is amended. We are having right now only two categories. First category may four assets are there. Second category balance all assets. First category may four assets, second category may balance all assets. So first category, I will be checking the period of holding as 12 months. If the period of holding is up to 12 months for these four assets, asset is called as short term. Otherwise, asset is called as long term. Sir, any other asset, if the period of holding is up to 24 months, asset is called as short term. More than 24 months, asset is called as long term. As simple as that. Sir, first of all, tell me what are those four assets? Aram I can say. Sir, first one though, listed securities that too recognized in Indian Stock Exchange. First asset though, listed securities recognized in Indian Stock Exchange. Sir, second thing though, units of equity oriented mutual fund. Units of equity oriented mutual fund. Sir, third one though, zero coupon bond, and fourth one though, units of Unit Trust of India. Guys, just remember, you no need to understand the exact meaning of all these items. You will slowly understand at your final level or in other subjects also. You may understand the meaning of other items. So no need to worry about all the meaning of this. Just remember for MCQ's purpose, these four assets period of holding we have to check is 12 months. Up to 12 short term, more than 12 long term. That's it. Sir, please tell along with me what are those four assets? Sir, listed securities recognized in Indian Stock Exchange, units of EOMF, zero coupon bond, units of UTI. That's it. For these four assets, my period of holding will be 12 months. Sir, all other assets, it will be 24 months. I will ask questions. You have to repeat along with me the answer. Sir, if the transferred asset is building, is it covered under these four assets? Answer is no. Therefore, how much period of holding I have to check, sir? Do I have to check 12 months or do I have to check 24 months? Right answer is 24 months. Sir, if it is up to 24 months, it is called as short term. If it is more than 24 months, it is called as long term. That's it. As simple as that. For example, sir, unlisted shares are there. Sir, unlisted shares are there. Now, for these unlisted shares also, the thing is very simple. Sir, for these unlisted shares also, if the period of holding, I have to check is 24 months because here only listed shares are covered. Sir, jewelry is there. Jewelry is also not covered under above 4. Therefore, for jewelry also, my period of holding will be 24 months I have to take. I hope the point is pretty clear. Sir, 4 assets, 12 months. All other assets, 24 months. Sir, if I have transferred any short-term capital asset, I have to pay short-term capital gain. If I have transferred long-term capital asset, I have to pay long-term capital gain. That's it. As simple as that. But just remember, for two assets, always I have to pay short-term capital gain irrespective of the period of holding. First one to section 50AA. Second one to depreciable assets. If I have sold, I have to always pay short-term capital gain only. Sir, why it is short-term capital gain? What is the process of finding out short-term capital gain? We will not discuss in this chapter. We will discuss in PGBP chapter. Because you have to understand how depreciation will be calculated, especially in case of depreciable assets as per income tax. Since I am not releasing PGBP before this capital gains, I will cover this depreciation का concept on capital gain in case of depreciable assets का concept in PGBP chapter. ठीक है? That is the thing which you have to understand. For these two assets, just remember always I will be getting short-term capital gains. ठीक है? Yes, sir. Sir, we have understood what is capital asset का meaning and what are the items which are excluded from the definition of capital asset also we have seen. Sir, we have also seen how many types of capital assets. What is the period of holding we have to check, that also we have completed. Next thing though, sir, if you remember the charging section, first of all, there should be a capital asset plus it should be transferred. Sir, what exactly is the meaning of transfer? That also let us try to understand. Sir, transfer means sale, exchange or relinquishment. Sir, sale means if I sold any asset, I will be receiving obviously consideration. That is also called as transfer. Exchange means, sir, I have given one asset, I have taken one asset. This is also called as transfer. Relinquishment means I have withdrawn, I have surrendered any right on asset. That is also called as relinquishment. That is also called as transfer. Extinguishment means, sir, asset itself is destroyed. Asset itself is not there. That is also called as transfer. Next thing, though, these are important, guys. Sir, these two are super duper bumper important. We are having subsequent discussion earlier. Compulsory acquisition of immovable property is also a transfer. Conversion of capital asset into stock in trade is also a transfer. Next thing though, transfer of immovable property as per TOPA if the three conditions are satisfied. First of all, see guys. Sir, generally how immovable properties will be transferred is seller and buyer both will be entered into an agreement. Consideration will be paid by the buyer. Then they have to register the property in the name of the buyer. Then only transfer is completed. That is the normal thing. But what the buyer is doing is, what the seller is doing is, buyer, you please pay me the consideration. We will enter into agreement. I will hand over the possession also to you. But if we take the registration right now, transfer is done, which means you will become the owner, which means I have completed the sale, therefore I have to pay the capital gains. I don't want to pay capital gains right now. So what we will be doing is let us postpone the registration. But every other formality is completed. I will hand over the keys to you. You can live with your family in that building. Aram say nicely. You have paid me the consideration. Agreement is also there. Understand? Department is saying, oh, if you think like this, we also know how to stop this. They are saying, okay, who said registration is mandatory? That is from outside person's perspective. But income tax is saying if you paid a consideration, if possession is transferred, if agreement is there, we will agree, we will what should I say? We will conclude the transfer is done. Therefore, you have to pay capital gain. Whether it is registered or not, we don't care. You have to pay capital gain. That is the point which they will be explaining in this transfer ka definition. So last thing though, maturity or redemption of zero coupon bond is also treated as transfer. Okay, fine. Just go to the transfer ka definition. In that, the most important points are this and this and this also. Next, let us discuss concept number 5, which is nothing but computation of short-term capital. Sorry, this is computation of short-term capital gain versus long-term capital gain, guys. Computation of short-term capital gain versus long-term capital gains. Just a moment, guys. Yes, sir. Understand the format, guys. Very, very simple. Sir, if any capital asset is there now, I have to transfer that capital asset. Sir, if I transfer any capital asset, obviously I will be getting something which is called as sale consideration, which is shortly called as SC. Sir, another name is also there for that SC, which is called as full value of consideration. Sale consideration or full value of consideration, initially I have to take this. Sir, normally for any immobile properties now, I have to deduct something which is called as expenses on transfer. Commission will be there, brokerage will be there, registration fees will be there. All these expenses I have to deduct, sir. Sir, then what I will be getting? I will be getting something which is called as net sale consideration. Sir, from this net sale consideration, remember very, very carefully, I have to deduct two items. Sir, what is the first item? I will be deducting cost of acquisition. Sir, second item though, I will be deducting cost of improvements. Sir, then I will be getting something which is called as gross LTCG or STCG. I will be getting, sir, gross LTCG or STCG. Sir, minus what I have to do is, guys, minus I have to do something which is called as exemptions under section 54 series. So then I will be getting something which is called as taxable long-term capital gain or short-term capital gain. Just understand the format, guys. No need to buy hard. This is completely logical thing. Sir, if I sell any asset, I will be getting the sale price. So that sale price is called as full value of consideration or sale consideration. Sir, minus what I have to do expenses on transfer. Then what I will be getting net sale consideration. Sir, minus two items I have to deduct cost of acquisition, second item cost of improvement. Then I will be getting gross long-term capital gain or short-term capital gain. Minus I have to do exemptions under section 54 series. Then I will be getting taxable long-term capital gain or short-term capital gain. Understand the catch. Sir, even if it is short-term capital gain or long-term capital gain, I have to follow the same format. Answer is yes, sir. We have to follow the same format. Okay, sir. Understood. We have to follow the same format. Sir, now I am having one doubt. Sir, if both are same, if both the format is same, sir, what is the reason we have to do bifurcation as any asset into long term and short term? Sir, you are saying format is same. You will get capital gain or long term. I mean, whether you will get long term capital gain or short term capital gain, both I will be getting in the same format. Sir, then what is the reason to do this bifurcation? Guys, that you will understand after I discuss the tax rates for the capital gains. That you will be understanding after I discuss the tax rates for this capital gains. We will be having different tax rates for long-term capital gains and short-term capital gains. That is the reason you will understand after discussing the tax rates. Okay? Yes, sir. So that format only I have explained here nicely. But one more super duper bumper clarity you have to get right now. Capital gains is completely revamped, and the brilliant observation which you have to make is, sir, one landmark date which is there, which is nothing but 23rd July 2024. Sir, this 23rd July 2024, you have to remember, because if there is any long-term capital asset, if there is any long-term capital asset, sir, if it is transferred before this date, I cannot take normal cost of acquisition. Remember, it is only for long-term capital assets. Sir, if it is short-term capital asset, na, this point is not applicable. Before this date or after this date, we will be doing the same accounting treatment. But sir, if it is long-term, plus if the date of transfer is before 23rd July 2024, what I have to take? I have to take indexed cost of acquisition instead of cost of acquisition. And I have to take indexed cost of improvement in case of cost of improvement. Understand, guys? But what they have did is they have removed the concept of indexation from this date onwards. Before also, indexation is only applicable to long-term capital assets. We will understand slowly at later point of time, sir, what exactly are the assets for which indexation is applicable. That we will understand. Don't worry, guys. Later we will understand. But right now, understand. Sir, do we have to remember this now also? Answer is 100% yes. In capital gains, the first thing I recommend you to check is, sir, what is the date of transfer? Sir, if the date of transfer is before 23rd July, you have to take indexation. If the date of transfer is after 23rd July, no indexation is applicable. Sir, first of all, what is this indexation? Please tell us. Guys, in order to understand this indexation, you just have to come here, which is nothing but cost inflation index number. Sir, what is this cost inflation index number? Guys, very simple. Sir, 10 years later, 10 years before, what should be the cost of tomatoes per kg? And right now, what is the cost of tomatoes per kg? Sir, are both the same? Answer is no. Sir, why? Because of inflation. Same thing will be there here also, guys. Especially for long-term capital assets, now it may be possible that you have purchased some asset at some 20 years back at 1 lakh rupee only. Now you are selling that asset at, for example, 1 crore. It may be possible because land and building values may be increased to this much. 100% chances are there. What they are saying is, okay, you can consider that's this inflation related benefit, but this inflation related benefit is applicable only till 23rd July 2024, which means after 23rd July 2024, indexation benefit is removed regardless of the holding period. One more thing. Here I have given the formula for indexed cost of acquisition and indexed cost of improvements. Indexed cost of acquisition is nothing but, sir, just remember in the numerator, I have to take the index for the year of transfer. Denominator, I have to take the index for the year of purchase, or 1 to 2001 to whichever is later. Sir, why whichever is later? That is logical. You will understand little bit slowly. But the thing is, sir, here if I purchase, for example, before this date, there is no indexation number because this is the first year. So if you purchase any asset before this date, now you have to take this index number only. Sir, why? You will understand slowly, guys. Don't worry. I am there now. Why are you worrying? Okay, so what we have to take is just example I am saying, guys. Sir, for example, I have purchased some asset in 2005-6. Sir, I have sold one asset in 24-25 previous year. Just write the indexation number for these 2 years. Sir, 2005-6, the indexation number is 117. So let me write here 117. Sir, 24-25, the indexation number is 363. So let me write 363 here. Just write the index numbers. Sir, 2005-6 I have purchased for 10 lakh rupees. What is the cost for this? That is nothing but indexed cost of acquisition. Sir, basic some math you have to do, which means 10 lakh into 363 divided by 117 if I do. Sir, I will be getting something which is called as 31 lakh 2,564. This is my indexed cost of acquisition. Basic math. If you don't know basic math, just by heart this formula. Here one into symbol is missing, guys, so please write into. Cost of acquisition into index of the year of transfer divided by index of the year in which SSE first held the asset, or 2001 to whichever is later. Sir, what is the meaning of first held the asset? I'm saying, wait, you will get clarity. Not even a single point I will give, guys. Understand? Sir, one more thing. Indexed cost of improvements means same thing you have to check. In denominator, I have to write whatever year you have incurred the improvement, and numerator, I have to write the year of transfer. Okay? Yes, sir. Understood this concept. But one more thing, indexation is only applicable when, sir, if asset is transferred before 23rd July 2024, which means they have removed the benefit of indexation from which date, sir? 23rd July 2024. This example is bumper duper important example, but this way will come after completion of tax rates, which I will be making at the end of this session. After completion of this tax rates, we will aram se check this part. Okay? Yes, sir. Understood the concept. The whole concept we have understood, sir. Okay. So next concept which we will cover is there are some transactions which are not treated as a transfer. Okay. So as per charging section, if you remember, two conditions are there. So what is the first condition? First condition should be there should be a capital asset plus it should be what? Transferred. If both conditions are satisfied, then only capital gain will be applicable. We have already understood the definition of capital asset as well as which is not a capital asset also we have already seen. So now transfer definition also they will cover above. So some transactions are there which are not treated as transfer. You have to understand if something is not a transfer, capital gain will not apply in that case. Okay, so that thing you have to understand. So now, whatever the transactions which are not treated as transfer is given in section number 47. It is also called as exempt transfer also. Okay, so fine. Here what they will say, if transfer of a capital asset by individual or HUF by way of three transactions are covered here. First one is gift, will or inheritance. It is very simple. If any person have gifted one asset or if any asset is transferred through will or inheritance, other person will not pay any consideration. So what these people will say is, okay, since you are gifting, it is given on will or it is given on inheritance. What they will saying is there is no need for seller to pay capital gain because it is not treated as transfer. Okay, let us take one example also. So Mr. Chiru is there, who is the owner of the building. Mr. Chiru have gifted his property to Mr. Ramcharan. Obviously, Mr. Ramcharan will not pay any consideration. So what they will say, since it is a gift, it is not treated as transfer in the hands of Mr. Chiru. Therefore, no capital gains in the hands of Mr. Chiru. This is the important point which you have to remember. Many cases, I will refer this example. If any asset is gifted, that will not be treated as a transfer. Always there is no capital gain in the transaction. This point is there, not that much important from tender point of view, but we can just check this point. If any HUF is there, any total partition or partial partition, whatever the assets which are distributed, that will also be not treated as a transfer. Simple. Just remember, if it is not treated as transfer, no capital gain will be applicable. Next point, transfer of a capital asset by, here they will cover four companies. So if any holding company is transferred to 100% subsidiary company, or if any 100% subsidiary company have transferred any asset to holding company, amalgamating company to amalgamated company, and demerged company to resultant company. In these four cases, they will say if any capital asset is transferred, one condition they will say transferee company should be an Indian company. Transferee company means the second company. For example, in the first case, 100% subsidiary company is called as transferee company. Holding company is called as transferee company in second case. Third case, amalgamated company, and last case, resultant company. This condition you have to check. Resultant company or transferee company should be an Indian company. Then it is also not treated as transfer. One more point. If it is transferred as a stock in trade, this exemption is not applicable. Simple. For transferee company, such asset should be capital asset. For transferee company, if such asset is stock in trade, this exemption is not applicable. Just normal point, not that much important from your exam point of view. Similarly, this point also, shareholders of amalgamating demerged company, these two company, if those are getting shares of the new company which is amalgamated or resultant company, here also it is not treated as transfer, therefore no capital gain will be payable by the shareholders of this old company which is amalgamating or demerged company. Okay, next up, but one condition they will say, amalgamated or a resultant company is an Indian company, which means whatever the second company which is discussed here, this should be treated as an Indian company, then shareholders will not have to pay any capital gain. Okay. So other points are there, 5, 6, 7, 8, 9, 10, 11 points. These are not that much important, but what we'll be doing is we will be covering, once we have covered all the important areas, then I will come to these points also and we will cover. Okay, fine. Next, most important concept number 7, we have to understand, which is nothing but a period of holding. Very simple. Period of holding, sir. Why it is essential to find out this period of holding is because in order to find out any asset as long-term capital asset or short-term capital asset, we have to find out period of holding. Based on period of holding only, we have to understand whether an asset is short-term or long-term. We have already seen earlier that we are having two categories of assets. For category A assets, the period of holding is 12 months, we have to check. And for category B, all other assets, we have to check the period of holding as 24 months. So very simple. Period of holding is nothing but from the date of purchase till the date of transfer, we have to calculate. From the date of purchase till the date of transfer, we have to calculate, and this period is called as period of holding. That's a simple case. So here what they will say, if any cases is covered in section 49 subsection 1 modes. Cases covered in section 49 1 modes. First, it is nothing but, write in brackets, it is nothing but indirect transfer cases. Indirect transfer cases. Indirect transfer means these cases. Transactions which are not treated as transfer, section 47, exempt transfer. If any asset is covered in this case, what I have to take is I have to take the period of holding of previous owner or previous, this is not amount, just a strike off this previous amount and write previous asset. Period of holding of previous owner or previous asset to be included. Okay, simple point. More about this point, I will cover in concept number that I will cover in concept number 10. But here just understand, period of holding is nothing but we have to take the previous owner period of holding. That's it. Please remember this. Shares held in the company in liquidation. This I will cover along with there is one concept which is liquidation. It is there at last if you check. So page number, concept number 19, it is there. So there I will cover about that liquidation point. So we can ignore this point also. Moreover, this is not that much important, but that liquidation we will cover nicely. So here what they will say, just they will say that in case of liquidation, what they will say is shares held in the company at the time of liquidation, what they will be saying is till the date of liquidation, till the company's liquidation, we have to consider the period of holding. After that, we have to ignore the period of holding is what they will say, but this is not that much important. Second point, we can even ignore also. Third point, right shares. Right shares is nothing but shares which are issued to existing shareholders at concessional price. That is the meaning of right shares. Here, the period of holding will be, companies will usually allot these right shares. So from the date of allotment, we have to start the period of holding. Next thing to rights. In case of this right shares only, shareholders are having the right to purchase the shares, or they are having the right also. If they want, they can even sell this right also. You have to understand the right to purchase shares is also treated as a right. So this is also treated as a capital asset because it is an intangible asset. As per capital asset definition, it includes all properties, whether tangible, intangible, movable, immovable, etc. Therefore, this right is also treated as a capital asset. More discussion we are having, which is nothing but right shares related discussion is pending. And bonus shares, here also we are having some discussion, but from the date of allotment, we have to check. Even if you ignore this concept number 7, we can still check that because it is covered indirectly in other concepts. Okay, so simple thing. Even if you ignore this period of holding, totally fine, because rights I will cover, bonus shares also I will cover later, liquidation also is there in this chapter only. One thing which you have to remember is this first case, special case, which is nothing but indirect transfer related cases. Here we have to check period of holding of previous owner or period of holding of previous asset, we have to find out. Okay, next thing, concept number 8 we have to understand. Here they will say components for calculating capital gain. If you observe the format, the first item which they will say is nothing but full value of consideration. Very simple. Full value of consideration means I have to take the sale value of the asset. If consideration is not ascertainable, for example, if it is received, if it is barter transaction means I have given one asset and I have taken another asset. Here no cash is there. So here what they will say, if consideration is not ascertainable, you have to find out FME of the capital asset received. That will become your full value of consideration. That's it. And one more point you can add here, even if it is received in installments, so we have to take the total consideration. The point is very simple. You cannot say that I have received only installment amount, so I have to pay capital gain only on this installment. You cannot say like that. You have to pay the capital gain on full amount. Okay, fine. After writing full value of consideration, second item which I will be writing is expenses on transfer. For example, normally if you are selling any immobile property or shares, etc., you have to pay something which is called as brokerage, commission, registration fees, etc. This will be called as expenses on transfer. These amounts are not the income of seller because these amounts have to be paid to some other broker or commission person, like that you have to pay. Therefore, this will be excluded for the purpose of calculating capital gain. Expenses on transfer I have to deduct. Next thing, cost of acquisition we have to take. Cost of acquisition, very simple, whatever the amount which you have paid to purchase that asset, that we have to take. But two items you have to remember. First thing, STT paid. STT full form you can write here. STT full form is nothing but securities transaction tax. Securities transaction tax. This is not allowed as deduction for the purpose of calculating capital gain. Remember this point. And one more thing they will say, but not if any expense is allowed as deduction under any other head. For example, if you have already taken any interest deduction under income from house property, same again will not be added in the cost of acquisition because double benefit is not allowed. Either take deduction under income from house property or take deduction under capital gain. That's it. Double deduction is not allowed under this head of income, capital gain. Okay, fine. We have completed this concept number 8. Now let us quickly move to concept number 9. Very simple. If any asset is purchased before 1/4/2001, if any asset is purchased before 1/4/2001, sir, what I have to take the cost of acquisition? Very simple, because our indexation table itself will start from 2001 to year. So if any asset I have purchased before this date, sir, what I have to do? I have to compare two items in this case. First, I have to take the actual cost. That actual cost should be compared with one item which is called as fair market value as on 1/4/2001, and whichever is higher, I have to take cost of acquisition. Very simple. Let us assume actual cost is 10 lakh rupees. Fair market value they have given 15 lakh. So in this case, whichever is higher is nothing but 15 lakh, and this 15 lakh will be treated as my cost of acquisition. Simple point. But this will be applicable only if any asset is acquired before 1/4/2001. The reason is very simple. If any asset is acquired after this date, we are having indexation number. So we can directly take indexation table number from the table. But if any asset is acquired before this date, we don't have indexation. Therefore, therefore, department people will say compare two items. First one actual cost, second item fair market value. On which date? 1/4/2001. In question, they will give other date fair market values also. You have to think smartly and we have to ignore other date fair market values. We have to only consider this fair market value on 1/4/2001. Whichever is higher, we have to take. But one thing also we have to check. Specifically, if they have given stamp duty value. Specifically, if they have given stamp duty value as on 1/4/2001, your FMV should be restricted to stamp duty value, which means your fair market value cannot be more than stamp duty value. Simply you can buy at this. So what we have to take? Normally we will take whichever is higher of actual cost or fair market value. But if they have given stamp duty value while taking fair market value, please compare with SDV. FME and SDV, please compare. Take whichever is lower, and that lower figure have to be compared with actual cost, and whichever is higher I have to take. Simple point. For example, fair market value, assume it is 10 lakhs. Stamp duty value, assume it is 8 lakh only. First, I will take whichever is lower, which means 8 lakh I will take first. If the cost of acquisition is 5 lakh rupees, I will compare 5 lakh or 8 lakh, whichever is higher. That's it. Simple point. Okay. Next thing, note point, if you observe, they will say cost of acquisition for intangible assets in case of self-generated. If it is purchased, we have to take the purchase price. Two types of intangibles will be there generally. First type of intangible is called as self-generated intangibles. Second type of intangible is called as purchased intangibles. Self-generated means very simple. For example, intangible asset, you can take goodwill as an example. If you are doing any one business from the last 20 years, you will develop something which is called as goodwill. If you are only doing that business, through that business only, you will be generating something which is called as self-generated goodwill, which means it is not purchased from any other person. You are only developing that goodwill. What the standard will say is, if you are only developing the goodwill, I cannot say how much cost I am incurring only to develop that goodwill. అంటే ఆ గుడ్‌విల్ కోసం మనం ఎంత కాస్ట్ పే చేస్తున్నాం అనేది మనకు తెలీదు. అందుకే వాడు ఏం చెప్తాడు, ఇట్ ఈస్ ఇంపాసిబుల్ టు ఫైండ్ ఔట్ ద కాస్ట్ ఫర్ దోస్ ఐటమ్స్. అందుకే సెల్ఫ్ జనరేటెడ్ ఇంటాంజిబుల్ షుడ్ బి ఆల్వేస్ రికార్డెడ్ ఎట్ నిల్, because it cannot be recorded in books of accounts. More clarity you will get in your accounts only in intangible assets standard. In AS 26 you will get, I think it is not there at your inter level. Interలో ఉందా AS 26? లేదు కదా. So in your final you will understand, while we study IND AS 38, then you will understand, sir, what is the meaning of internally generated intangibles, and all we will understand. But here just remember, internally generated intangibles, which are called as self-generated, you have to take the cost as nil. But if you have purchased it from any other person, they will give you purchase price. So please take the purchase price. And one more thing, for intangible assets, this benefit of fair market value is not applicable. Which means if any intangible is given, if it is purchased, even if it is purchased before 1/4/2001, I still have to take the original cost only. Fair market value I cannot take. Okay, that's it. And one more thing, cost of improvements, if you observe, they will say additions or alterations to capital asset. For example, if you take an example of building, if you take, you have purchased that building when it is having only ground floor. At that time, you will incur something which is called as cost of acquisition. But now what have happened, after completion of 5 years, you have constructed first floor. Then this first floor will be called as cost of improvements. So very, very simple. What they will say, cost of improvements means additions or alterations to capital asset. One thing you have to remember, if any cost of improvement is incurred before 1/4/2001, we have to ignore. We have to ignore if any cost of improvement is incurred before 1/4/2001. Let me take an example also to understand that. Okay. So this example we have already discussed in regular class. One person have purchased house property for 10 lakh rupees in previous year 95/96, which means it is before 1/4/2001. In 97/98, this person have constructed first floor, and the cost of improvement which he have incurred is 2,50,000. If you observe, this improvement is before 1/4/2001. If any asset is acquired before 1/4/2001, we already know that we have to take something which is called as fair market value on 1/4/2001. That should be compared with your actual cost of acquisition, which means is 10 lakh rupees. 10 lakh and 20 lakh, whichever is higher, I have to take, which means I will obviously take 20 lakh rupees. So my cost of acquisition is sorted. One more thing, sir, what about this cost of improvements? This have to be ignored. Sir, why it have to be ignored? Understand. Here, while taking fair market value on 1/4/2001, I will take the fair market value of that house which already have this first floor. Which means already this fair market value captures this improvement also. So again, don't take this improvement separately. because here I have incurred even before 1/4/2001 while taking fair market value. I will take the fair market value of such property which contains first floor also. Therefore, what they are saying is, okay, since you are already taking improvement value in fair market value on 1/4/2001, ignore this. Ignore this improvement. But after, if it is there, you have to consider after wala improvements. After 1/4/2001, if any improvement is there, we have to take that 1/4/2001 after improvements. Okay, simple as a point. So that's it. Next thing, if you observe carefully, we are having something which is called as concept number 10. Here they will say cases covered in indirect transfer. We have to understand this example very, very carefully. Mr. Chiru have gifted an asset to Mr. Charan. Gifted, just now I have explained, sir, gift is not a transfer. If gift is not a transfer, first of all, this building is a capital asset. Fine. Building is a capital asset. Plus, it is not a transfer. Therefore, no capital gain will apply in the hands of Mr. Chiru. But later, what have happened? This Charan have sold his asset to Mr. Ravi. Sir, same asset he have sold. Yes. First of all, it is a capital asset. Plus, now it is a transfer because it is not gift. Now it is not a gift because it is treated as a transfer. Therefore, capital gain will be applicable in the hands of Mr. Charan. Again, I am repeating. For Chiru, there is no capital gain, but for Mr. Charan, there is a capital gain. Because simple, we have to just connect with charging section. Capital asset plus transfer. Therefore, capital gain will be applicable in the hands of Mr. Charan. Now the question is, while calculating capital gain, full value of consideration means I will take whatever the Charan have sold to Mr. Ravi. That sale consideration will be treated as full value of consideration. Minus expenses on transfer if they have given separately. I will also take that part. But the crucial part here we have to understand is, sir, for this Mr. Charan, what will be the cost of acquisition? For this Charan, what will be the cost of acquisition? We have to understand. What they will say is, Charan have not purchased the property. Obviously, Charan have taken the property on gift from Mr. Chiru. Therefore, Charan's cost of acquisition will be zero. If Charan's cost of acquisition will be zero, total consideration will become capital gain. Which means on the total consideration, Charan have to pay the capital gain, which is not correct. Therefore, what they will say is, okay, while taking cost of acquisition, please take cost of acquisition of previous owner. Mr. Chiru have purchased the asset. Mr. Chiru should have purchased the asset. Therefore, Mr. Chiru will be having some cost of acquisition. So, cost of acquisition of Mr. Charan, we have to take cost of acquisition of Mr. Chiru. You may get one more doubt. Sir, what if Chiru also have not purchased the property? What if any other person have gifted the property to Mr. Chiru? Then for Chiru also, there will not be any cost of acquisition. At least one person have to purchase. Na? Any one person have to purchase. That previous owner's cost of acquisition we have to take. Okay, that's it. Improvement cost also, we can take cost of improvement of previous owner. But one more thing. It should be incurred on or after 1/4/2001. Then you can take. If it is incurred before 1/4/2001, then I have to ignore. Because anyways, cost of improvement will be ignored if they have incurred before 1/4/2001. But you can take previous owner ka improvements even if it is paid by the previous owner. If any improvement is incurred after 1/4/2001, we can consider those improvements also. Here what they will be saying is period of holding also you can take off previous owner. This is the point which is there above here, this point. Special cases, first point, they will say that point only. Period of holding also you can take previous owner's period of holding. That's it. Last thing, indexation benefit also you can take previous owner. Indexation benefit also you can take previous owner. Understand carefully what they will say. In case of indirect transfer, you have to remember the four things. Cost of acquisition, I can take previous owner. Cost of improvement also, I can take previous owner. Period of holding also, I can take previous owner. Last but not the least, indexation benefit also I can take from the previous owner. But one thing you have to remember. Act is saying, Income Tax Act is saying, you can take indexation benefit only from the year in which SSE have held the property. Indexation benefit is saying from the year in which SSE is having the property, from that date onwards only we have to start indexation. But Act is saying no problem, you can take the indexation also from the previous owner, is what the Act is saying. So please give us one example, then you will understand exactly what I'm trying to say. So what I will be saying is, let us take this example. Mr. Pavan have gifted one house property to Mr. Charan in the year 2005-6. Charan have sold the property in 25-26 previous year. Now, if you observe carefully, for Pavan it is not a capital gain, but for Mr. Charan, capital gain will be applicable. Here, if you observe carefully, I will take Pavan's cost of acquisition as Charan's cost of acquisition. If any cost of improvement is incurred by Pavan, I will take cost of improvements of Charan. These improvements I will consider here. But one more thing you have to understand, indexation benefit as per Act, it is saying it is applicable only from the previous year in which SSE first held the asset. In our case, SSE is Mr. Charan. Sir, SSE is holding the asset. SSE is holding the asset from this date onwards only now. 2005-6 only asset is having. Asset is holding by the SSE. Act is saying before this period, asset is not yours. Therefore, indexation also you cannot take from before here. Act is saying indexation, please take from this year. But one famous case law is there, which says since you have taken cost of acquisition from here, period of holding also from here, cost of improvements also of previous owner, you can take indexation also from the previous owner. That is as per case law. But Act is saying from this date onwards only you are holding the asset. Therefore, please take indexation also from this date only. Sir, what is correct? Both are correct. In exam, what we have to do? Anything you can do, but write some note. Anything you can do, but you have to write some note. That's it. And one more thing. Sir, what if the previous owner have purchased before 1/4/2001? I have to take fair market value as cost of acquisition. And one more thing, indexation also I will take from 1st April 2001. Simple, whichever is later I have to consider. Same point is also there in above, wherein I have discussed the formula for capital gain also. Index for the year in which SSE first held the asset, or 2001 to whichever is later. In concept number 5, here there is little table which is there. While calculating indexed cost of improvement, same thing they will say, whichever is later we have to consider. I hope the point is pretty clear. Okay, so now let us understand concept number 11 also, wherein indexation benefit is not applicable in the following cases. Indexation benefit is not applicable in the following cases. Let us understand. We all know that indexation benefit is removed from 23rd July 2024 onwards. Which means, sir, after 23rd July 2024, if any long-term asset is transferred, indexation benefit is removed. Indexation benefit is removed except one case. Except one case, sir. What is that case? That case is nothing but land or building plus individual or HUF plus acquired before 23rd July, transferred after 23rd July. One case is there. I will cover that case. Towards last chapter, there is some concept which is called as tax rates of capital gains. There I will cover what we have to do there. Okay, simple point. Fine. But sir, for some assets, even though they have transferred before 23rd July 2024, there is no indexation. If it is a long-term capital asset and if it is transferred before 23rd July, there is indexation. But from 23rd July, they have removed. But some assets are there, even if they have transferred before 23rd July 24, there is no indexation. Sir, what are those assets? First thing, na, short-term capital assets. For short-term capital assets, there is no indexation only. You have to remember this because indexation is only applicable for long-term capital assets. That too before 23rd July. Second thing, slump sale. Section 50B, most important section at the CA levels, CA inter and CA final, both attempts. The moment I am writing at my CA inter also, they have tested this question. When I am writing my CA final also, they have tested this concept. Slump sale question, but this is not that much important from your syllabus point of view, but I have included this concept here only. In this chapter only I have inserted, wherein I will discuss at last, if I am not wrong. Last concept is there. Concept number 23 I have given about this slump sale only, section 50B. There I will cover. Sir, what is the meaning of slump sale and all? I will explain clearly. Okay, simple point. Slump sale concept number 23 I will cover. But just remember, for slump sale also, indexation is not applicable. For slump sale also, indexation is not applicable. And one more thing. Section 112A also indexation is not there. Sir, section 112A, it is long-term capital gain only. But some stock market incomes, they will say about the section 112A. Always remember, for section 112A also, indexation is not applicable. What is the tax rate and all, I will explain. But here you have to just remember, indexation is not applicable. And one more thing, depreciable assets or market linked debentures or specific mutual fund, please write in brackets section 50AA. Market linked debentures or specific mutual fund పక్కన రాసుకోండి section 50AA. If you observe carefully, for depreciable assets or market linked debentures, always I will get short term capital gain only. Period of holding చెప్పినప్పుడు చెప్పే point. For depreciable asset or market linked debentures or specified mutual fund, always I will get short term capital gain. If you are always getting short term capital gain, obviously indexation is not applicable. Obviously, indexation is not applicable. This also you have to remember. Next page, if you observe, sir, for non-resident also, indexation is not available. Indexation is available only for resident persons. Sir, this non-resident taxation is not at all there at your inter level. This non-resident taxation you will understand at final level. But just remember, for maybe for MCQ also, they will not generally ask. But since it is there, I am just discussing. So please understand this. Residents only, indexation benefit is applicable. For non-residents, even before also, there is no concept of indexation. Last point, debentures or bonds. Debentures or bonds also, you just have to simply check this point. Okay, that's it. For these assets, even if any asset is transferred before 23rd July, indexation benefit is not applicable. Sir, what is the first asset? STCA, short-term capital assets. Next, slump sale, 112A, depreciable assets or market-linked debentures. These two assets always we will get short-term capital gain, so no indexation. And after that, non-resident also there is no indexation. Last but not the least, debentures or bonds also there is no indexation. Simple is a point. Maybe it is little bit important for MCQs. So just to check this point, 2 to 3 times you can just check this. Now comes concept number 12, which is nothing but treatment of advance money forfeiture. Concept number 12, which is nothing but treatment of advance money forfeiture. Simple. First of all, advance money forfeiture is nothing but cancellation of advance money. For example, I am having one property. I have decided to transfer the property. One buyer have approached me and he have paid me some advance. Let us assume he have paid me advance of 10 lakh rupees. Later, what I have decided is I don't want to sell the property to that person, or buyer only don't want to purchase from me. Sale is cancelled, but I have already received some advance. What the department is saying is, okay, you have received some advance, but see, if sale is cancelled, transfer is not taken place. Therefore, you will not pay any capital gain. But future, if you sold that asset, now I have not sold asset, but after 2 years, I have got some new buyer and I have sold the property to that person. Now transfer is happened. I have to pay the capital gain. Understand? For future time, there is no capital gain. But you just have to remember the treatment. While transfer only, during that transfer only, you have to check the date of forfeiture. And if this forfeiture is before 1/4/2014, the treatment is you have to reduce from cost of acquisition. Check the date of forfeiture. If it is before 1/4/2014, what is the treatment? I have to reduce from my cost of acquisition. But if the forfeiture is on or after 1/4/2014, I have to tax that under income from other sources. Simple as a point. If it is before 1/4/2014, while calculating the capital gain, I have to reduce from my cost of acquisition. But if the forfeiture is on or after 1/4/2014, I have to tax that item under income from other sources. Forfeiture, which means second case is there na, taxable under income from other sources. In the question, if they are asking you to give the capital gain, in the question, if they are asking you to find out the capital gain, I have to ignore this. I have to ignore this. But if it is done before 1/4/2014, while calculating capital gain in the year of transfer, I have to reduce that from cost of acquisition. That's it, you have to remember. Forfeiture of advance also we have completed. Just you have to remember the date. If it is done before 1/4/2001, reduce from the cost of acquisition. If it is done on or after 1/4/2014, I have to tax that income under tax that forfeiture under income from other sources. Okay, so that's it. Now, concept number 13, most important section. In this concept, three sections will be covered. From those three sections, there are high chances from which questions will be generally asked. Okay, so very, very important. You can keep double star mark with this concept number 13, which we will cover very nicely. Okay, so let us cover this concept number 13 also, which is very important. From exam point of view, they can ask directly on 7 marks question from this area. So let us understand this very carefully. As per charging section, we know that capital gain is always taxable in the year of transfer. For example, if any capital asset is transferred in the previous year 25-26, obviously capital gain is also taxable in 25-26 only. But there are few exceptions. Starting, I have said there are few exemptions which we will study later. So now we will study all those exemptions. Three exceptions are there. First exception is if any capital asset is damaged or destroyed and you have taken insurance, therefore you will receive something which is called as insurance compensation. That is first section, which we will cover in section 45 subsection 1A. Second section is conversion of capital asset into stock in trade. This they have given in charging section, sorry, in definition of transfer only they have said that if any capital asset is converted into stock in trade, that is called as what? Transfer. And one more thing, compulsory acquisition of immovable property by central government. This also they will cover in the definition of transfer only. So three sections you have to remember. Here you have to remember section numbers also. First section 45 subsection 1A. Second section 45 subsection 2 and third section 45 subsection 5. Most important. Let us understand each of the following sections in detail. First of all, sir, one capital asset is there. That capital asset is destroyed. What I have did is I have taken insurance on that capital asset and the insurance company is paying me compensation. Correct? This is what covered in this section 45 subsection 1A. Here, if you observe, they will say if any capital asset is destroyed for these specified damages only. Specified damages means they will clearly given the definition. They have given cyclone, hurricanes, earthquakes, accidental fire or civil disturbance. If any accidental thing have happened to your asset, you have taken insurance, you are receiving compensation. Yes, then only this section is applicable. For example, I only intentionally have did some fire accident. I only intentionally have did some accident. This is not a specified damage. This is not a specified damage. Theft is not a specified damage. Whatever they have covered, only this section is covered. Simple. Normally, if I sold any asset, if I receive any amount, I have to pay capital gain. Similarly, what these people will say is, you are having some asset, that asset is destroyed, and you are receiving compensation from insurance company. This is similar to sale of an asset only. But see, sale of asset also you will sell the asset, you will give the asset. Here also you are giving the asset. Asset is destroyed. Whether you are receiving amount from insurance company or buyer, that doesn't make any difference. Both are same, so you have to pay capital gain in both the transactions. But understand, sir, in the year of destruction, the company have suffered huge loss. Now I cannot ask in the year of destruction only to pay the capital gain. It is very logical. Therefore, they will say, okay, don't pay capital gain in the year of transfer only. In the year in which you have received the compensation from insurance company, in that year you have to pay the capital gain. Very logical, correct? They are very sad. The asset itself is destroyed. You cannot ask that person to pay the capital gain. It is not correct. It is not justifiable. So what they will say, okay, wait till you receive the compensation. In the previous year in which you have received the compensation, you have to pay the capital gain. Understand? This is the important point. Fine. Sir, okay, we have understood. First of all, if I have taken any insurance compensation, my asset is destroyed because of the specified damages, then that is treated as a transfer and I have to pay the capital gain. Not in the year of transfer, but in the year in which the compensation is received. Fine. Sir, while calculating capital gain, what I have to take as full value of consideration? Very simple. Insurance company, sometimes it will give you cash. Sometimes it will give you new asset. For example, if they have given you cash, Take that cash. If they have given you fair market value, just take the fair market value of the capital asset received on the date of receipt of compensation. That's it. This only you have to calculate. So cost of acquisition or cost of improvement, as usual, I can take. Understand most important part, indexation benefit. Indexation benefits in brackets I have written if applicable, which means before 23rd July it should be transferred. What they will say is, sir, let us assume my asset is destroyed in 23-24. Compensation is received in 25-26. It is very clear. Taxable in 25-26. It is taxable in 25-26 only. But asset is destroyed in this year only. Therefore, 24-25, I don't have any asset. Therefore, I cannot take indexation benefit till 24-25. I have to stop indexation till the year of destruction. Basic point. Because after that asset is not there now. So I have to stop indexation till the year of destruction only. That's it. 45 subsection 1A is completed. Full value of consideration, I have to take cash or fair market value of any asset received. Cost of acquisition will be normal. Indexation benefit will be applicable till the year of destruction, and it is taxable in the year in which compensation is received. Very, very simple point. One more thing you have to remember. Sir, if compensation is received from other damages, what is the meaning of other damages? Other damages means, for example, theft or any intentional fire accidents. Theft or any intentional fire accidents, if you observe, these are not taxable. These are not taxable. And one more thing you have to remember, super important point. Sir, my asset is destroyed. If my asset is destroyed and I have not taken insurance, if I have not taken insurance, I will not receive any compensation. If I have not taken any insurance, obviously I will not receive any compensation. If I do not receive any compensation, my full value of consideration will be nil. If my full value of consideration is nil, I will get capital loss because I will have cost of acquisition but no sale price. Therefore, I will obviously get loss. Here, what they will say is that loss will be treated as dead loss. Because, sir, what is treated as transfer? If you observe carefully, sir, if any asset is destroyed, that is not treated as transfer. Any asset should be destroyed and you should be receiving insurance compensation. Then only it will be treated as transfer. Simply speaking, asset destroy అయ్యి మీకు ఇన్సూరెన్స్ కాంపెన్సేషన్ రాకపోతే it is not treated as transfer. If you receive insurance compensation, it is treated as transfer. అంటే వాడు ఏం చెప్తాడంటే కాంపెన్సేషన్ వస్తే ట్యాక్స్ పే చేయమంటాడు కానీ కాంపెన్సేషన్ రాకపోతే దట్ లాస్ కెనాట్ బి సెట్ ఆఫ్ అగైన్స్ ఎనీ అదర్ లాసెస్. దట్ ఈస్ ద మీనింగ్ ఆఫ్ డెడ్ లాస్. I cannot set off, I cannot carry forward. Simply, I have to ignore that loss. Okay, simple sa section. Only one question is there for this section. 45 subsection 1A. There we have to solve this question. And one more thing. Sir, one fire accident have happened. On the date of fire accident, some furniture is destroyed. One capital asset building is also destroyed and stock in trade is also destroyed. If you observe carefully, furniture is not a capital asset. Stock in trade is also not a capital asset. If something is not a capital asset, this section is not applicable. Sir, but building is a capital asset. For building, yes, this section is applicable. Because starting I have said, furniture and stock in trade are excluded from the definition of capital asset. Therefore, they are not capital assets and this section is not applicable. Simple as a point. Next. One question is there. You have to solve that question, guys. And one more thing. Second section we will start, which is nothing but section 45, subsection 2. Here they will explain, sir, conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade. Let us take one example, then you will understand this question. One entity is there, which is a software company. For that person, one building is there. Sir, for software company, building will be obviously a capital asset. Now, this person have decided to close this software company and he have decided to start one new business which is called as real estate business. Understand? Sir, in previous year 2021, this person have converted this capital asset into stock in trade, because for real estate business it is called as stock in trade. This person have transferred this asset from software company to real estate business. He have converted the asset, not transferred, he have converted the asset. If you observe carefully, sir, this real estate business will use this building. It will make some small constructions and it will divide into multiple flats and it will sell to its customers. Therefore, for this real estate business, this is called as stock in trade. If you observe carefully, sir, let us assume this conversion is happened in previous year 2021. Now what have happened is, sir, as per definition of transfer, transfer includes conversion of capital asset into stock in trade, which means conversion is taken place in previous year 2021, which means this is obviously the year of transfer na. But if you observe carefully, sir, this company, software company, will not get any consideration in the year of this transfer. So then when it will get the consideration? Right answer is the moment it is making sales to its customers now. At that point of time, it will be getting some cash. It will be getting some consideration. Yes, sir. Therefore, what they will say, okay, capital gain you have to calculate. Capital gain will be taxable not in the year of transfer, but in the year in which you actually sold the stock. Logical. You need money to pay the capital gain. Therefore, they will say in the year of conversion, you will not receive the cash. So wait till you sell the stock. In the year in which such a stock was sold, you have to pay the capital gain. You have to pay the capital gain. Understand? Easy as a point. So come here fastly. Come to concept book. Sir, taxable in the previous year in which such a stock is sold. One more thing, sir, indexation benefit will be applicable till which year? Guys, remember, indexation is applicable only till the year of transfer. Transfer is 2021. Therefore, till 2021 only indexation benefit is applicable. But taxable will be in the year 25-26. Simple as a point. And one more thing. Sir, while calculating capital gain, now I have to take full value of consideration. Sir, what I have to take full value of consideration? Very, very simple. In the question, they will always give you fair market value of the capital asset on the rate of conversion. Fair market value of the capital asset on the date of conversion, directly I have to take as full value of consideration minus cost of acquisition will be as usual. Indexation benefit will be applicable till the year of conversion, and last but not the least, taxable in the previous year in which such stock was sold. 45 subsection 2, only you have to remember these 4 points. That's it. Smart students will understand one more point. Sir, if it is a stock in trade, later, if I have sold this stock in trade in previous year 25-26, sir, we know that stock in trade is not a capital asset. If I sell any stock in trade, obviously this person's business is real estate now. If those persons have sell stock in trade, that should be taxable under PGBP. That should be taxable under PGBP. That is logical. Very logical. Sir, but you are saying capital gain is also taxable in the year of such sale. Guys, understand carefully. Two transactions are there here. Sir, first transaction is that capital asset is converted into stock in trade. Second transaction is that stock in trade is sold. Two different transactions, two different taxabilities. Sir, first though, capital gain taxation will be because this capital asset is converted into stock in trade. But just taxable in the previous year in which such a stock is sold. One more thing, sir, in that year my stock is also sold now. Therefore, I have to pay capital gain also. Sir, are you telling is this double taxation? Answer is no. Sir, but just now you are saying you also have to include that item. You also have to pay capital gain as well as PGBP. Sir, how it does not be falling under double taxation? You have to understand this point. Sir, in the year in which such a stock was sold, capital gain will be calculated. In addition to capital gain, I also have to find out PGBP income also. Sir, how I will get PGBP income? Very, very simple. Actual sale value they will give in the question. Minus Fair market value of the capital asset on the date of conversion. Whatever we have taken to find out capital gain, that amount should be treated as a cost, because you have already paid capital gain on that amount now. So reduce from your PGBP income. Otherwise, you have to pay double tax. And one more thing, conversion expenses. Sir, capital asset means that building is there. Also have to incur few expenses now to convert that building into what's this, a finished good. So that item will be treated as, those items also will be allowed as deduction. Conversion expenses also. Simple. Sale value of the stock minus fair market value minus revenue expenses. And one more thing, sir, what if entire stock is not sold? For example, I have constructed 100 flats. I am able to sold only 60 flats. Then only proportionate capital gain will be taxable. You will receive only amount for 60 flats now. Therefore, pay only 60% of the capital gain in the current year. Sir, what about 40%? Are they exempted? No, they're taxable in the next year. If you have not sold in current year, next year you will sell. So next year when you are selling the balance flats, that balance capital gain will be taxable. That is the point which they will mention here. If entire stock is not sold, only proportionate capital gain is taxable in the previous year in which such asset is sold. Okay, simple is the point. Most important for this point also, we are having one question, we have to solve that question. Sir, which questions I have to solve also, I will explain, don't worry. At the end, I will explain that part also. Okay. And next section, we have to understand, which is nothing but section 45, subsection 5. Another important section. So let us understand this also in detail. Okay. So next section, which is section 45, subsection 5. The last exception of this charging section, which is nothing but compulsory acquisition of immovable property by central government and compensation is determined by central government or RBI. Simple. When immovable property is there, central government has initially, it will ask you to sell the property. For example, there are many situations, for example, road widening. If your property is in between the road, government will ask you to remove that road. First, they will ask you to sell the property to them. If you sell, it is fine. Otherwise, they will do compulsory acquisition. What they will say, if you have any property which is compulsorily acquired by the government and if the compensation is determined by central government or RBI, simple thing. What they will say, that is also treated as a transfer. That will be given in transfer definition. And one more thing, if you observe carefully, first of all, think from buyer, think from seller point of view. That person don't want to sell the asset first of all, but government have compulsorily acquired and they are also asking him to pay the capital gain. First of all, he is very depressed because he don't want to sell the asset, but you have taken that. Anyways, you have taken that. But now you are asking him to pay the capital gain also, which is totally injustice to that person. So what they will say, okay, please wait till you receive the compensation. Once you receive the compensation, in the year of compensation, you have to pay the capital gain. You have to pay the capital gain. That's it. But here what we'll be having, two types of compensations will be there. First of all, government assume the property value is 100 crore. But the government have decided to pay only 50 crores compensation. But you are not satisfied with that 50 crore. So you have went to court and the court have given an order to pay 30 crores extra compensation. That 30 crore extra compensation is called as enhanced compensation. And initial compensation means normally whatever they have given 50 crores, that will be called as initial compensation. Understand one thing. While calculating sale consideration for the purpose of initial compensation, what I have to do is just check this point. In case of initial compensation, if it is received in installments, entire compensation is taxable in the previous year in which the first installment is received. Very simple. It is applicable for initial compensation. For example, initial compensation is 50 lakh rupees, but they are only paying me 10 lakhs in the first year and they are paying balance 40 lakh in the second year, for example. Even though you have received 10 lakh rupees as first installment, you have to pay the capital gain on the total 50 lakh in the year of first installment only. In the year of first installment only, you have to pay the total capital gain. This is applicable for initial compensation. But if it is enhanced compensation, how much you have received, you have to pay the capital gain on that amount only. If you receive only part amount, you have to pay the capital gain on that part uh, compensation only. You have to pay the capital gain. Okay? Yes, sir. And one more thing, if you observe carefully, sir, cost of acquisition I will take for this initial compensation normally, and for this enhanced compensation, cost of acquisition will be nil. The reason is very simple. The total cost of the property I have utilized to calculate this initial compensation only. Therefore, for enhanced compensation, it will be nil. Expenditure on transfer money, legal or litigation expenses, both for initial as well as enhanced compensation will be applicable. Very simple. It is taxable in the previous year in which such compensation is received. It is taxable in the previous year in which such enhanced compensation is received. But always remember, indexation will be applicable till the year of transfer only. Here, the transfer year means compulsory acquisition year only. So till that year only, indexation benefit will be applicable. For enhanced compensation, there is no cost of acquisition. Therefore, indexation is also not applicable. Okay, so that's it. This section is completed. And one more last point is there. If any compensation is received through interim order from a court or tribunal, you have to check it is taxable in the previous year in which the final order is passed. You have to wait till you receive the final order. In the previous year in which the final order is received, that amount will be taxable. Okay, yeah. So this section also we have completed. And one more thing is there, which is nothing but exemption under section 10 clause 37. This is a little bit important for your MCQ, so understand what will happen. I am having one urban agricultural land. I am using that urban agricultural land from the past 2 years. I am using for agricultural purposes only. Now, if I compulsorily acquired, if my land is compulsory acquired by the government, I have to pay normally capital gain because it is urban agricultural land. If it is rural, there is no capital gain. But since it is urban, I have to pay something which is called as capital gain. They are saying since it is compulsory acquisition by the government, that to central government or RBI, they are saying it is exempted. So don't pay capital gain in this situation. Okay, fine. 50 double A capital gain in case of market linked debentures. Very, very simple. Sir, market linked debentures means those debentures whose price is dependent on market. Those are simply traded like normal shares. At inter level, just remember these three assets. Always you will get STCG. That's it. They will not ask any questions from this section. In case if they ask, you just have to remember the section number and which capital gain you will get. That's it. Remember just both. These 2 points only you have to remember. Unlisted shares, unlisted debentures or bonds after 23rd July 2024. This is transferred on or after. It is not taxed. Third point, you have to change to transferred on or after 23rd July 2024. It also always I will get a short-term capital gain. You just have to check whether I am getting. You just have to remember that I will be getting capital gain, short-term capital gain on these three items. Just remember the section number and remember you will always get short-term capital gain in these transactions. That's it. And super important section, you can keep 5 stars for this section 50C. You can keep 5 stars for this section 50C. Without this section, there is no question paper. This 50C, let us understand very in depth. This is applicable only when the transferred asset is land or building or both. When the transferred asset is land or building or both, you just have to compare two items. Sir, first item though I have to take stamp duty value. Second item I have to take 110% of actual consideration. Compare these two items. If your stamp duty value is more, if the answer is yes, then my full value of consideration will be stamp duty value. Sir, if my actual consideration is more than this stamp duty value, if my stamp duty value is not more than 110%, then full value of consideration will be actual sale consideration only. Let us solve some examples and you will get the total clarity on this. Okay, let us take few examples. Stamp duty value, they have given 60 lakhs. Sir, actual consideration is only 50 lakhs. Actual consideration is only 50 lakh. So I have to compare two items, stamp duty value and 110% of actual consideration. So stamp duty value is 60. Actual consideration into 110% if I do, I will only get 55 lakh. Sir, here my stamp duty value is more, therefore full value of consideration, I have to take stamp duty value only. Very simple. Sir, second case, so actual consideration is 70 lakh. SDV is 60. If I take, see, actual consideration is only more now. Therefore, obviously, 110% is only more than this stamp duty value. Therefore, here my SDV is not more than 110% of actual consideration. So, therefore, full value of consideration will be 70 lakh rupees only. Just understand these two examples once again. You will aram say understand whatever the provision which I am discussing here. Sir, the reason for introducing this provision is many people will sell the property less than stamp duty value. Many people will sell the property at less than stamp duty value, sir, because if they do so, their full value of consideration will be less. If it is less, their capital gain will be less. If the capital gain is less, they will pay less capital gain. They will pay less tax. Like this, most of the people will plan. Therefore, department people are saying, even though if you are selling below stamp duty value, if it is more than 110% of actual consideration, you have to always take stamp duty value only as full value of consideration. This is the point which you have to remember. Just check this point once again along with examples also. Just pause the video for 5 seconds and you have to copy these examples and you have to analyze these examples what I have written here. In questions, you will aram se get the total clarity. Okay? Yes, sir. Now, one more point is also there here only. First of all, sir, two dates are possible. Generally, for these immobile properties, what we'll be doing is, if you are selling these immobile properties, obviously they will be sold for huge prices. For example, 50 lakh, 2 crore, 1 crore, like this only it will be sold. It is not possible for the buyer to arrange the total funds on a single day. Therefore, generally what these people will do is, first they will enter into one agreement. They will enter into agreement. Sir, why they will enter into agreement? Because it is very simple. Sir, if they decided to sell to one person today, after 1 month, if there is no agreement, that person will change the buyer. That person will change the buyer and he will decide to sell to some any other person. That's why, just to be on a safer side, buyer and seller both will be entered into one agreement. Now, what have happened is, sir, on the date of agreement, one stamp duty value will be there. But suddenly, what have happened is 3 months after I have decided to do the transfer, I have decided to do the registration or transfer date. This can be different. Sir, what have happened is agreement date, let us assume it is 30th April 2024. And sir, after 3 years, sorry, after 3 months, which means 31st July 2024, I have decided to register. Sir, meanwhile, what have happened is some capital announcement is made near that land, because of which land prices have increased hugely. On this date, stamp duty value is only 60 lakh. But suddenly, on this date, stamp duty value is increased to 80 lakh. It may be possible. Sir, here what we have to take is, sir, if date of agreement and date of transfer both are different, my preference is I have to give stamp duty value on the date of transfer. But if two conditions are satisfied, I can take stamp duty value on the date of agreement also. Sir, what are the two conditions? First condition is, sir, I have to pay either full consideration or part consideration up to the date of agreement. Up to the date of agreement, if I receive any consideration, either full or part. That too in only three modes. Account pay check, account pay demand draft, or electronic clearing system. Only in these three ways, if I receive any consideration up to the date of agreement, then I can take stamp duty value on the date of agreement. Otherwise, always I have to take stamp duty value on the date of transfer. Most important point, the second point. And one more thing, sir, I have received consideration before the date of agreement only, but not using these three methods. I have got in cash, I have got in bearer check, I have got in crosser check. In these three cases, even if I receive before date of agreement, I always have to take stamp duty value on the date of transfer because these are not covered here. Sir, here what are covered? Only account pay check, account pay demand draft, or ACS is only covered here, which means this is not covered. Another important point, you have to check this. And third point, this is also super important. Sir, if SSE fails, SDV is more than fair market value. Which means, sir, you have said that 50C will be applicable when people are selling below their stamp duty value. But sir, what have happened is, sir, stamp duty value is 100 lakh. But if I observe the fair market value, it is only 80 lakh. There is no buyer. If I want to sell the property at 1 crore, there will be no buyer which will come. That is a genuine case. Sir, I cannot sell the property at 1 crore rupees, so please do something. SSE is having two options. First option, he can go to court. Second option, sir, SSE is feeling stamp duty value is more than fair market value, but SSE don't want to go to court. He is having one more option. He will ask the assessing officer, hey, please, assessing officer, please transfer this case to valuation officer. Then assessing officer can refer. Now what have happened is, sir, assessing officer or the valuation officer have find out the value, and he have said that, sir, value determined is 120 lakhs. Sir, stamp duty value is only 100 lakhs. But valuation officer have given 120 lakhs. This is totally unfair. This person have thought, sir, this 100 lakh is only more. But now they are saying even more value. They are saying 120 lakh. He have decided, sir, this 100 lakh is only injustice. But valuation officer have did even more injustice. Here, what I have to take, sir, you have to take whichever is lower. Here they are giving 1 point which is favorable to the SSE only. They will say whichever is lower, you have to take as full value of consideration. Sir, what is the meaning of whichever is lower? 120 or 100, whichever is lower, which means 100 I have to take as full value of consideration. Sir, but value is not 120, sir, value is only 90 lakhs. Simple. Sir, I thought 100 is more. Now the valuation officer have found out the correct value and he is saying only 90 lakhs. In this case, what I have to take? Again, whichever is lower. It is beneficial provision for the SSE. Therefore, SSE have to take 90 lakh as full value of consideration. That's it. Full value of consideration will be value determined by the valuation officer or STB determined earlier, whichever is lower I have to take. That's it. That's it. Super important. Section 50C we have completed. 3 points you have to remember. Along with me, please revise. First point. If stamp duty value is more than 110% of actual consideration, if it is yes, then my full value of consideration will be stamp duty value. If no, my full value of consideration will be actual sale consideration. Second point, sir, if date of agreement and date of transfer both are different, I have to take stamp duty value on the date of agreement, provided that I have received either full consideration or part of the consideration up to the date of agreement by way of account pay check, account pay bank draft, or electronic clearing system. Otherwise, I have to take the stamp duty value on the rate of transfer only. Sir, if I receive in cash, if I receive in parent check, or if I receive in cross check, I still have to take as DV on the rate of transfer only. And one more thing, sir, if SSE feels the stamp duty value is more than fair market value, SSE can request assessing officer. Assessing officer can transfer the case to valuation officer. Then full value of consideration will be value determined by the valuation officer or stamp duty value determined earlier, whichever is lower, I have to take. That's it. And one more thing, concept number 16, capital gain in case of bonus shares. Sir, bonus shares are nothing but shares which are issued at free of cost. Since they are issued at free of cost, your cost of acquisition will be zero. Sale consideration though normal we have to take, they will give in the question. Sir, if I sold the bonus shares at 100 rupees, I have to take this 100 rupees as sale consideration. Expenses on transfer, if they have give, I will consider. Sir, cost of acquisition will be generally nil because you will not pay any amount to purchase this bonus shares. They will give you free. Period of holding you have to take from the rate of allotment. There I have covered. Great. Here. Period of holding you have to take from the rate of allotment. 1 second. Here guys, bonus. Okay, fine. Now, cost of acquisition will be generally I have to take nil. But remember the point, sir, if the bonus share is allotted before 1/4/2001, I have to take the fair market value on 1/4/2001 because it is very simple. Sir, if any asset is before 1/4/2001, I have to take cost or fair market value, whichever is higher. So if the cost is zero, obviously my fair market value will be higher. Therefore, I have to take fair market value. That's simple. And one more thing, concept number 17, capital gain in case of right shares. Simple. So the difference between bonus and right shares are, sir, bonus shares means free of cost, right shares means concessional price. Both are issued to existing shareholders only at concessional price. Understand? So the company's share price is trading at 200 rupees right now. It is issuing right shares to existing shareholders. That shareholder, if you want, you can purchase the share at 90 rupees only. They are giving an option to the shareholder because you are anyways the shareholder. The company is having some profit, so you can purchase the share if you want at 90 rupees only. Shareholder is having two options. Sir, if he really wants the company shares, he can purchase those right shares. Sir, if he want, how much amount he have to pay? He have to pay 90 rupees to the company. Pay 90 rupees and purchase the shares. Sir, later what this person have did is, sir, this person have sold these right shares for 300 in the market after 1 year or 2 years, anything it can happen. This person have sold for 300 and at the time of purchase he have paid 90 rupees, which means this 90 will become the cost of acquisition. This 90 is only called as rights issue price. Simple sub point. Shareholder, if he purchases the right shares, right price will be called as the cost of acquisition. Rights issue price will be called as the cost of acquisition. And one more thing, sir, this person is having another option also, that if you don't want these shares, sir, one outsider is there. That outsider wants to purchase the share. That outsider, if he wants to purchase the share, he have to pay 200 rupees. But the shareholder is having an option to purchase at 90 only now. Sir, now this person is having the right to sell. This person can sell the right to purchase these shares also to that third party. Which means, understand, this shareholder, if he wants, he can purchase at 90 or he can sell the right to purchase the share at 90. Sir, what exactly you are trying to say? Sir, one shareholder, one third party X is there. Shareholder is, let us assume, A. Mr. X wants the shares, but if he wants, he have to pay 200. Therefore, he went to Mr. A. Mr. A, you are having a right to purchase at 90. I want that right. I want that right. That right cannot be transferred for free. That person have to pay some price. Mr. A have to receive some price now. Mr. X have to pay some price. Sir, if you observe, this is nothing but right. This is nothing but sale of right to purchase the right shares. Sir, is it a capital asset? Yes, it is an intangible asset. If I sell now, obviously, how much amount I will receive? For example, let us assume this person is transferred for 20 rupees. This 20 is called as sale consideration. And one more thing you have to understand is, sir, for the purpose of this right, there will not be any cost of acquisition because this will be given as free. For this right, there is no cost of acquisition. I hope the point is clear. Cost of acquisition will be nil because the right is given free. Just because I'm a shareholder, I have got this right. Now, so this X have purchased the share for 20 rupees. Now, he also have to pay 90 rupees to the company. Now he is having a right to purchase at 90. If he want the shares, he have to obviously pay 90 rupees. Sir, later this X have sold these shares at 300 in future. 300 will be the sale consideration minus, if you observe carefully, sir, what is the total cost of acquisition for this Mr. X? 20 he have paid to Mr. A and 90 he have paid to the company, which means, sir, can I say that total 110 will be the cost of acquisition? Answer is yes. This is only I have written here. Amount to pay to shareholders plus amount to pay to company for acquiring such a share. We have to check this part. Okay. So that's it. We have completed till here. Till concept number 17, we have completed. Most important concepts we have done. And after that, super important exemptions are pending. From these exemptions also, definitely they are going to test some questions. If any immobile property question comes, they will ask from section 50C. Plus they will mix any of the exemptions, for example, 54, 54F or 54EC. Like this, they will combine three sections, any of the three sections. Plus 50C they will give and they will ask you few questions. Okay, so you have to be very careful in those sections. Here I have written some three very important A++ sections which you should not miss. Some other miscellaneous sections also I have quoted here, but our first preference should be always we have to give preference to these A++ sections. Simple point. If you remember the format of capital gains, after gross long-term capital gain or short-term capital gain, I will deduct something which is called as exemptions under section 54 series. In that 54 series, we are having totally 5 important exemptions. Other exemptions are also there, but these are only most important from your intermediate level. 54 exemption. Understand. Sir, I have transferred one asset, therefore I will get some capital gain. I will get an exemption if I make any investment in new asset. If I sell an asset, I will get capital gain. If I am purchasing a new asset with that amount, I will be getting some exemption. That's it. The concept of exemption is very simple. You have to invest some amount, you have to invest such amount in some assets. If you do an investment, then only you get an exemption. That's it. Concept is simple. First one, those are section 54. If the transferred asset should be residential house property, which is long term, this is shortly called as long term RHP. This should be transferred. You will get some capital gain. Obviously, I have to utilize that capital gain to purchase another residential house property in India. I have sold one RHP. I am purchasing another RHP, that too in India. Understand? If you are purchasing outside India, you will not get any exemption. You have to purchase in India only. And one more thing. Sir, if my capital gain is only up to 2 crores, I can purchase two residential house properties. Both I have to purchase in India only. Simple as a point. Sir, my long-term capital gain is 6 crores. How many properties I can purchase? Only one property you can purchase. Sir, but if my long-term capital gain is only 1 crore, I can purchase two RHPs and both should be in India only. I hope you are getting the point. Sir, 54. Transferred asset should be long-term residential house property. Purchased asset should be another residential house property in India. If the long-term capital gain is only up to 2 crores, so I have to purchase two residential house properties. I can purchase two residential house properties. So the time limit is very simple. In case of purchase, see, new house property you can either purchase or you can construct also. If you want to purchase, you can purchase before 1 year the date of transfer or 2 years after the date of transfer. If you want to construct, you can do after 3 years from the date of transfer. Simple. If you want to purchase, you can purchase before 1 year the date of transfer or 2 years after the date of transfer. If you want to construct, you can do the construction only after 3 years from the date of transfer. Sir, what is the amount of exemption? Very, very simple. You have to compare two amounts, investment in new asset or capital gain, whichever is lower. Sir, I am making an investment of 60 lakhs. Sir, my capital gain is 80, whichever is lower, which means I will get only 60 lakh as exemption. Sir, my new investment in asset is 80 lakh. Capital gain is 60. I will get an exemption only of 60 only, whichever is lower we have to take. Very, very simple point. Compare two amounts, investment or capital gain, whichever is lower. That's it. And one more thing, sir, maximum exemption will be restricted to 10 crores only. Maximum exemption will be restricted to 10 crores only. Okay? Yes, sir. More than 10 crores you cannot get. And one more thing, sir, if I purchase new asset now, I cannot transfer that new asset for a period of 3 years. Lock-in period. Whatever the new asset which you are purchasing, that you cannot transfer for 3 years. Sir, what if I transfer? If you transfer, whatever the amount of exemption which you have taken earlier, now that amount of exemption will be reduced from cost of acquisition. That amount of exemption will be reduced from the cost of acquisition. You can just write one more point, in the year of violation. In the year of violation. Lock-in period lasts lower, and if transferred within 3 years, amount exempt shall be reduced from cost of acquisition in the year of violation. In the year of violation, which means whenever you have violated within 3 years, if you have transferred that asset, you have to reduce that item from the cost of acquisition in the year of violation, which means whatever the exemption which you have taken earlier, that should be cancelled right now. Simple section. 54. So transferred asset, long-term residential house property. New asset, another long-term residential house property in India. But if the SSE is capital gain is up to 2 crores, you can purchase two residential house properties, but both should be in India. Sir, what is the time limit? 1 year before the date of transfer, 2 years after the date of transfer. In case of purchase, in case of construction, 3 years after the date of transfer. Sir, what is the amount of exemption? Capital gain invested, sorry, capital gain amount or amount invested, whichever is lower. But maximum exemption is only restricted to 10 crores. Sir, what is the lock-in period? 3 years is the lock-in period. If I have decided to transfer the asset within 3 years, whatever the amount of exemption which I have taken earlier, that should be reduced from cost of acquisition in the year of violation. This is section number 54. Now, immediately come to section number 54 EC, which is there in page number 76. 54 EC, if you observe carefully, sir, asset transfer should be any long-term capital asset, being land or building or both. Understand, there only residential house properties covered, but here land or building or both. Sir, it is applicable for all SSEs, but if you compare section 54, it is only applicable for individual or HUF. See, this is residential house property now, which means obviously individuals only will reside or members of HUF. These two people only will reside. Therefore, for this individual or HUF only 54 exemption is applicable. But 54 EC, if you observe, asset transfer should be long-term capital asset. It can be anything. It is not residential house property only. It is applicable for all SSEs. Sir, whatever the new asset which I have purchased, that should be bonds which are redeemable after 5 years. Sir, five entities they will say. NHAI, National Highways Authority of India, RECL, Rural Electrification Corporation Limited, PFCL, Power Finance Corporation Limited, Indian Railways Finance Corporation Limited, HUDCO, Housing and Urban Development Corporation Limited, last but not the least, IRADA, which is nothing but Indian Renewable Energy Development Agency. These agencies, if you purchase the bonds, for you, 54 EC exemption is applicable. And one more thing, sir, what is the time limit? Time limit is 6 months only from the date of transfer. Most important. Sir, amount of deduction, investment in capital asset or capital gain, whichever is lower, we have to take. Maximum exemption is only restricted to 50 lakhs. Sir, one more thing, this 50 lakh is not applicable for each category. This 50 lakh is applicable for all the bonds. All the bonds put together, maximum exemption is only 50 lakhs. Sir, lock-in period to 5 years from the date of acquisition of bonds. Within 5 years, you cannot sell. Sir, what if I sell? Whatever the exemption which you have taken earlier, that will be taxable as long-term capital gain in the year of violation. In the year of violation, that will be taxable in the year of violation as capital gain. Whatever the exemption which you have taken earlier, that is taxable. Okay, simple sub point. Now come to 54F. 54F if you F 54F if you observe. Asset transferred should be any long-term capital asset other than residential house property. Other than residential house property, whatever the asset which I have transferred, and if it is long term, it is covered in 54F. For example, I am having a jewelry which is a long term. If I have transferred that, it will be covered in 54F. Provided I have to purchase new asset which is another RHP in India. Simple is the point. This is also applicable only for individual HF because you are purchasing residential house property. Wherever residential house property is there it is applicable only for individual HUF. Just a moment. So fine. Sir, new asset should be another RHP in India. Transferred asset should be any LTCA except RHP. And one more thing you have to understand. Sir, what is that one more thing which I have to understand? Let me show you. Okay, see. Sir, assume SSE is having one house property in Hyderabad. Now that person is selling jewelry and he is purchasing another RHP in Bangalore. Sir, for this person, other than the new house, he is having one residential house property. This is new house. If I ignore this new house, so this person is having one RHP. If he is having one RHP, for him exemption is applicable. If he is having one RHP, for him exemption is applicable. Sir, what are you exactly trying to say? Let us assume, sir, this person is having one more RHP in Bangalore also. This person is already having two RHPs, which means more than one. Now we have transferred the jewelry and have decided to purchase another RHP. Other than the new house, this person is having two RHPs. This is not allowed. Other than new RHP, if the SSE is exactly having one RHP, exemption is available. Other than the new, if SSE is having two RHPs or more than one RHP, it can be 2, 3, 4, 5, whatever it is. If he is having more than two, exemption is not applicable. SSE should not own more than one RHP other than the new house. And one more thing, sir, after the day purchase of new asset, now SSE cannot purchase one more RHP. For example, sir, let us continue this example only. That person is having, other than new RHP, one house he is having. What they are saying is, after this new purchase also, you cannot purchase one more asset. This is fine. But other than this, you cannot purchase one more asset or you cannot construct another asset also. Simple sub point. Sir, for how many years I cannot purchase? You cannot purchase for 2 years. You cannot construct for 3 years from the rate of transfer of original asset. That's it. And one more thing, sir, time limit for acquiring the new asset now same as section 54. Same as section 54. Limit of exemption, sir, normally till now we have understood the limit of exemption will be capital gain or investment in new asset, whichever is lower. But here they will give some formula amount. This is not a separate formula. This is proportionate amount. Sir, whatever the capital gain which you have got, that should be multiplied with amount invested divided by net sale consideration. Then you will get exemption amount. Sir, what is the logic? Very simple. If you have invested entire net sale consideration in new asset, your full capital gain will be exempted. Otherwise, only proportionate capital gain will be exempted. Simple. Just read the formula once again. Capital gain into amount invested divided by net sale consideration. This you can strike off. If capital gain exceeds, if amount invested exceeds 10 crores, I have to ignore such excess. Simple as a point. So lock-in period for new asset is 3 years. Sir, if I have transferred the new asset within 3 years, or if I have purchased another asset within 2 years or constructed within 3 years, whatever the exemption which I have taken earlier, that should be taxable in the year of such violation. That exemption will be taxable. And one more thing, sir, for 54, 54B, 54D, 54F, what they are saying is, sir, the time limit is very big. Time limit is 1 year, 3 years, like this. But what they are saying is, you have to file your return of income in the next year only now. Most of the people are taking the exemption in the current year, and they are saying that I will be purchasing after 2 years, because anyways, if you observe the construction, they are having the limit of 3 years. So that person is misutilizing these provisions. They are taking exemptions, but they don't know whether they are actually purchasing that asset later or not. We don't know. So what they will say, you are having two options. If you want exemption, directly purchase the asset, or within the due date of filing the return of income, you just have to deposit such amount in one account which is called as CGAS. That is a separate account which you have to keep only for the purpose of that asset. From that only you have to purchase either that asset, or you have to do an investment only in the asset within the time limit. Okay? If you have invested that in that within that time limit, then only they will give you exemption. Otherwise, exemption will not be given. Okay, just read these points normally. Normally, you can understand these points. And other things, this 54B or 54D, so easy some points you can just directly study from this book. Okay, no need for me to explain. Just to check wherever exemption is there. Okay, these are self-explanatory points. You can around check this 54B and 54D as well. Okay. Now the next part, concept number 19, which is nothing but taxation at the time of liquidation. It is covered in section number 46 of the Income Tax Act 1961. You just have to understand this carefully. So the meaning of liquidation is, company is basically closing its operations. Company is selling all its assets, and company is paying all the liabilities. And whatever the balance cash is there, after paying even to debenture holders or even preference shareholders, the final cash will be distributed to equity shareholders if the company is having funds. If the company is not having funds, it is not mandatory for them to pay the cash to the equity shareholders. I hope the point is pretty clear. Yes, sir. Sir, now what will be happening is, company under liquidation, whatever the assets which are there, if it is selling in the market first, sir, those are company's assets. It is very similar that company is transferring those assets. Sir, capital asset plus transfer, therefore capital gain will be first applicable in the hands of the company. And this capital gain should be, I mean, whatever the cash which the company have earned, that should be distributed to shareholders. Correct or not? Yes, sir. Now think from shareholders' point of view also. Sir, till now shareholders are having their shares. Now the company itself is not there. Therefore, the shares also will be extinguished. Shares also cannot be there. So extinguishment also will be considered as a transfer. Therefore, shareholders also have to pay the capital gain, assuming his shares are sold. Two transactions are there here. First transaction, while the company is selling the assets, it should pay capital gain. Second transaction, so while the shareholders are actually receiving the cash at the time of liquidation, it is very similar that They have sold their shares, therefore they also have to pay the capital gain. We don't have any questions on this concept. Still, institute have to test this, but you just have to understand the concept nicely. Sir, second thing can happen. Company, instead of selling those shares in the outside market, the company can directly sell those assets to shareholders only, which means the company will distribute the assets to shareholders only. For example, especially in case of a private company, if minimum shareholders are there, the company will say, hey shareholder Mr. A, you take the land of the building. Hey shareholder Mr. B, you can take the building of the company. Hey shareholder C, you can take land which is located in Mumbai. Like this, instead of selling those assets in the outside market, if they are directly distributing the assets to shareholders, it is taxable only in the hands of shareholder. It is taxable in the hands of shareholder only on account of transfer of shares. On account of transfer of shares. Sir, which capital gain is taxable in the hands of shareholder if you have observed? Sir, we are having one section which is nothing but deemed dividend under section 2 clause 22 clause C, 2 subsection 22 clause C. There they will have some interlinking with this liquidation cutting. To the extent the company is having accumulated profits, to that extent it will be treated as a deemed dividend. More than that, if they are paying, that will be categorized as what should I say, capital gain should be calculated. Sir, what I have to take, if you observe carefully, you have to take the fair market value. This full value of consideration, we can take full value of consideration as fair market value of assets received on the date of liquidation. This is minus deemed dividend under section 2 clause 22, sorry, 2 subsection 22 clause C. With respect to this point, we unfortunately we don't have any questions, but still, yeah, we have covered this point as well, but little bit important. Liquidation time. Two things you have to remember, sir. If the company is selling its asset in the outside market directly, company have to pay capital gain. And later, while distributing such cash to shareholders, shareholders also have to pay the capital gain. So if the company is directly distributing those assets to shareholders, then it is taxable in the hands of shareholders on account of transfer of shares. I hope the point is pretty clear. Yes, sir, we have understood the concept. And concept number 20, which is nothing but taxation of buyback. Sir, buyback is nothing but company if it is having excess cash, company if it is having more profits, it should, what it should think basically is, sir, the company want to dilute its share. For example, one major shareholder is there, that major shareholder wants to increase his stake. Increase his stake, then what he can do is he can purchase the securities from other shareholders by the company, and later he can purchase from the company, which means his stake will be increased. Multiple reasons are there for this buyback. I'm not going into all those reasons that you will anyways learn in your accounting or even in law also, that relation to the discussion relating to buyback will be there. So then we can cover aram se. What they will be saying is, sir, buyback is nothing but companies purchasing shares from the shareholder. Think from shareholder's point of view, sir, shareholder is actually selling those shares to the company. Therefore, he have to pay the capital gain. Therefore, he have to pay the capital gain. That should be the normal treatment. But earlier, what will be happened is, earlier, company will be paying something which is called as buyback tax. Company will be paying something which is called as buyback tax. Now they have changed this provision, and what they are saying is, sir, from this date, 1st October 2024, they are saying whatever the money which the shareholder is received with respect to buyback of shares, sir, that will be called as deemed dividend. That will be called as a deemed dividend, and this discussion I will be making in the income from other sources. Simple as a point, buyback. Just remember this date. If buyback is done on or after 1st October 2024, sir, it should be taxable. It should be taxable as deemed dividend. It should be taxable as deemed dividend. I hope the point is pretty clear. Yes, sir, the point is pretty clear. So now come super duper bumper important sections. LTCG under section 112A and STCG under section 111A. Trending sections of this capital gains. If you observe carefully, so these are what should I say? Shortly called as a stock market incomes. Sir, three types of assets are covered. Those three types now. Those three types now. If those three assets are long term, they are covered in section 112A. Sir, if those three assets are short term, they are covered in section 111A. Sir, what are those three assets? Can you please tell me? Answer is yes, 100% I can tell you. Sir, first thing, to equity shares of a company on which STT is paid at the time of purchase as well as transfer. Second asset to units of equity oriented mutual fund. Third to units of business trust. Sir, for these two assets, STT should be paid at the time of transfer. But for the first asset, STT should be paid even at the time of purchase as well as transfer. If those three assets are long term, they are covered in LTCG under section 112A. Again, please understand. So, three assets. First one to listed equity shares. Only for these listed. See, STT paid means generally STT will be paid only for listed equity shares. So, you can aram se remember like this also. Listed equity shares, but STT should be paid at the time of both purchase as well as transfer. So, second thing to units of equity oriented mutual fund. Third thing to units of business trust. If these three assets are long term, I will pay the tax under section 112A. Sir, if these three assets are exactly short term, I have to pay STCG under section 111A. But understand, for these two assets, STT should be paid only at the time of transfer. Sir, but if it is short term, for all the three assets, STT should be paid at the time of transfer only. Only for long term. The two for this first asset, STT should be paid at the time of both purchase as well as transfer. But other assets के लिए STT should be paid only at the time of transfer. I hope the point is pretty clear. You should get proper clarity with respect to these three assets. If those three assets are long term, they are covered in section 112A. Sir, if those three assets are short term, they are covered in STCG under section 111A. I hope this point is damn clear. If clear, we can directly start with the tax rates. First, then I will continue. Sir, tax rates though, for those three assets, whatever I have discussed just now, the tax rate is 12.5% in excess of 1,25,000. Earlier, I have said that, sir, 112A, even before 23rd July also, there is no concept of indexation. But even now also, there is no indexation. The tax rate is 12.5% in excess of 1,25,000. For example, if you have received 2,50,000 rupees, this long-term capital gain, just to do minus 1,12,000, sorry, just to do minus 1,25,000. Whatever the difference which you have got now, that you have to multiply with 12.5%, your long-term capital gain will be this much only. So next thing to LTCG under section 112 if you observe. Sir, LTCG under section 112 means all assets other than 112A. For example, sir, building is there, long-term building. I have to pay tax under LTCG under section 112. Sir, jewelry is there. That jewelry is long-term. I have to pay capital gain tax under section 112. Sir, unlisted shares are there. I have to pay capital gain under section 112. Other than those three assets, every asset will be covered under section 112 only. Sir, what is the tax rate, sir? Sir, the tax rate is 12.5% without the benefit of indexation. 12.5% without the benefit of indexation is the tax rate which should be applicable. Aram se understand. Sir, from 23rd July onwards, indexation benefit is removed. They have reduced the tax. Now the tax rate is 12.5% without the benefit of indexation. Sir, earlier, before 23rd July 2024, there is the concept of indexation. Sir, when that indexation is there, sir, what is the tax rate then? If you ask me, sir, the tax rate will be 20% with the benefit of indexation. Sir, if indexation is there, because of this indexation, my cost of acquisition will be more. If my cost of acquisition is more, my capital gain will be less. If my capital gain is less, I have to pay less capital gain tax. Which means, sir, indexation is one kind of benefit for the shareholder. Huh? Indexation is definitely benefit for the shareholder. But suddenly from 23rd July onwards, they have removed the benefit of indexation now. Which means all the people, all the persons, all the public will feel like why you have removed the benefit of indexation. They will question like this. So what they have did is, sir, earlier the tax rate is 20%. Now they have removed one benefit, correct? Indexation. Sir, in order to satisfy the public, they have reduced the tax rate. Earlier it was 20%, but now they have reduced it only to 12.5%. Understand carefully. Sir, ఒక benefit తీసేశారు కాబట్టి another benefit they have to give. Now they have given 12.5%. They have reduced the tax rate, but indexation benefit is removed. I hope you have understood the logic. But public are still saying, even though you have reduced the tax rate, we are not satisfied with few assets. With the two assets, we are not satisfied. Sir, what are those two assets? Land or building? Land or building, even though you have removed, even though you have reduced the tax rate, we will be getting more benefit from this indexation only. Okay, you have reduced the tax rate, but more than that, if indexation is there, we are getting more benefit. Then department have said, okay, to some extent, what we can do is we can give you more benefit. Not complete benefit, to some extent only they are saying we will be giving more benefit. Then they ask us, okay, what is the extent of benefit which you are giving to us? Then they have said that, okay, you are saying for land or building, you are getting more benefit from the indexation, correct? Okay. See, we are saying from 23rd July 2024 onwards, indexation benefit is removed. So after this date, if you purchase any land or building, you already know that indexation benefit is not available. Therefore, after this date, if you purchase and later if you have sold such land or building, we will not provide you any benefit because you know that indexation is not applicable. Still you have purchased and now you are selling such asset. Therefore, for you, no benefit is applicable. Sir, but what about some poor people who have purchased it before 23rd July 2024 because they don't know that indexation is not there. They don't know that indexation will be removed from that date now. So in order to give the benefit to those poor persons who have acquired before 23rd July 2024, but sir, I have transferred after 23rd July 2024. Understood the logic, guys? Sir, if any person purchased before 23rd July, transferred also before 23rd July, indexation is applicable. But here, sir, if any person is there, especially those two assets only, other assets we don't care. But only for those two assets, they are saying if you have purchased any land or building before 23rd July, and if you have transferred that honor after 23rd July, for you, they have said that okay. Earlier, if the tax rate is there, I mean, first of all, calculate the tax under this amendment, which is 12.5% without indexation, just to calculate the tax amount. This should be compared with previous tax rate, which means, okay, take indexation and find out 20% on that. Take indexation and find 20% on that, which means calculate the tax two times. Whichever is lower, please pay the tax. Whichever is lower, you have to pay the tax. Guys, listen this point once again because this is the crucial part of the discussion. Sir, I am a poor person. I have purchased it before 23rd July, sir. I have thought that indexation will be there. My cost will be increased. My capital gain will be reduced. My capital gain tax will be reduced. Like that, I have thought and I have purchased the land before 23rd July. But you are suddenly saying that you have removed the benefit of indexation. Okay, don't worry. Think indexation benefit is still there. Now calculate the capital gain. 20% with indexation. That should be compared with the 12.5% without indexation, whichever is lower, pay the tax. For example, so I have computed 20% with indexation, it is 1,50,000, just example. Or sir, 12.5% without indexation, I have got only 1 lakh rupees. I have to pay whichever is lower, which means 1 lakh. Whichever is beneficial. Sometimes it can be beneficial, sometimes it can be beneficial. Okay, do as your wish. Take whichever is lower and pay the tax. Many of the students will think, sir, if this is the case, they have given complete benefit to public, they have given complete benefit to seller only na, because anyways whichever is lower I have to pay. But understand what the institute have did. Whatever the calculation which you have to do here, that is only for the purpose of paying capital gain tax. That is for the purpose of paying capital gain tax only. While finding out capital gain, you have to always do without indexation only. Sir, again repeat the point. For the tax payable only, I have to calculate two items and whichever is lower will be paid. For capital gain calculation, always I have to calculate without the benefit of indexation only, which means what you have to do is one brilliant example is there. You have to solve that example, guys. Only then you will be understanding whatever I was trying to say. Sir, if you check this question, Mr. Ravi purchased a house property whose cost is 5 lakh rupees. This question I have given. On the date of 1st October 2025, house property is sold for 18 lakh rupees. Brokerage at the rate of 2%. They are asking me to find out the capital gain. Capital gain also they are asking, and they are asking to find out the tax on CG also. Let me show you the calculations. Check this. I want you to pause this video and do the calculation. Sir, the date of transfer in this question is 1st October 2025. Therefore, sir, indexation is not applicable. While calculating capital gain, I have taken normal cost of acquisition, normal cost of improvement. And I have got the capital gain as 10 lakh 14,000. Sir, now while calculating the tax amount, I have to calculate into 12.5%. Sir, if I calculated 12.5%, I have got 1,26,750. Sir, this amount should be compared with 20% on LTCG with indexation. Sir, now I have to recalculate the capital gain by finding out indexed cost of acquisition and indexed cost of improvements. Sir, then my taxable capital gain will be this much. Sir, if I am getting a loss, tax will be zero. I no need to pay any tax. Which means, sir, here I have got this much. Here I have got nil. Whichever is lower means I will not pay any tax in this case. Some people will think, sir, if there is no tax which you have to pay, it is considered as benefit for no benefit for you, na. But if you observe carefully, if someone asks you what is my capital gain, I will say this is my capital gain. But tax will be zero. If you observe carefully, sir, my capital gain is not this one. My capital gain is this only, but my tax payable is nil. Some students will not understand. Sir, why I am saying is, sir, if I take the benefit of indexation, I will be getting loss na. This loss though, two benefits are there. Sir, first though, there should not be any tax. Second thing though, I can set off this loss with another income. Then my total income will be reduced. But this benefit is not given because they have only given this calculation for the purpose of tax on capital gain only. While calculating capital gain, you have to always take this amount only, which means you have not got any loss. Therefore, set off is not possible. I hope the point is pretty clear. Guys, this is marathon going on, but still I have explained very in depth. I hope you have understood my point. ठीक है? Yes, sir, we have understood your point. LTCG ka tax rates are completed. So now comes STCG under section 111A, the tax rate is 20%. All other STCG, remember, normal rates are applicable. All other STCG, normal rates are only applicable. Sir, what is the meaning of normal rates? Normal rates money, slab rates. Normal rates means slab rates. Yes, sir, we have understood the concept of this. And one more thing, if you ask me, sir, for three assets, one more thing, guys, here it is applicable. This benefit is only applicable for resident individual or HF. If you are a non-resident, this benefit ka calculation is not applicable. Remember this part. ठीक है, sir. Unexhausted basic exemption limit is only applicable for these three items. Unexhausted basic exemption limit means, sir, if I am having this incomes also and other normal incomes also, which are less than basic exemption limit, whatever the income which is less than the basic exemption limit, I can utilize that amount from this amount, and I have did the calculation. Regular classes, I have did some examples also based on this, guys. Okay, unexhausted basic exemption is only applicable for these three incomes. That is also only for resident individuals or HF. And one more thing, so rebate is applicable for all incomes except 112A. This we have seen in the basics chapter also. Chapter 6A reductions are not applicable against this STCG and STCG. For all special incomes, this is not applicable. टैक्स रेट्स के लिए हम बेसिक चैप्टर रेफर करना पड़ेगा, which means slab rates, normal rates, default rates, all those things we have already covered in the basics का chapter. I hope the point is pretty clear. कि yes sir, the point is clear. Now comes one more point which is there for MCQ's purpose. This point is very simple, very important. Sir, while calculating long-term capital gain under section 112A, na, if any asset is acquired before 31st January 2018, you have to take the cost of acquisition as higher of cost of acquisition or lower of fair market value on 31st Jan 2018 or sale proceeds, whichever is lower. First find out whichever is lower. That should be compared with actual cost. Whichever is higher will be your cost of acquisition. MCQs के लिए this is important. So just to check this point. Okay. After this, one more thing you just have to check: capital gain on transfer of virtual digital assets. Here you can just understand, sir, there are some assets which are nothing but cryptocurrency, any other notified digital assets. Just remember this section number. Virtual digital assets are shortly called as VDA also, and the tax rate is flat 30%. Flat 30%. And one more thing, sir, no expense is allowed as deduction except the cost of acquisition. Only cost of acquisition is allowed as deduction. And one more thing, sir, loss on transfer of VDA also will be treated as a debt loss, which means it is very similar to casual incomes. Yes, sir, we have understood this concept. Last but not the least, we are having the concept which is called as a slump sale. Sir, what is the meaning of slump sale? If you ask me, sir, slump sale is nothing but transfer of an undertaking for a single consideration without assigning individual values for each asset or liabilities. Which means, sir, I am having one division and I wanted to transfer the total division to another entity. I am not selling individual assets or individual liabilities. I am selling the total division as a whole without giving consideration values to each asset. Here the thing is, guys, unfortunately, there are no questions in our institute based on this. But you just have to remember how to calculate this thing. While finding out sale consideration, you have to take two numbers and take whichever is higher. First one to FME of capital asset transferred. That should be compared with FME of capital asset received. Take whichever is higher. Sir, my cost of acquisition will be net worth of assets transferred. Sir, what is the meaning of net worth? Net worth is nothing but total assets minus outside liabilities. While calculating this net worth, na, sir, for depreciable assets, you have to take WDV as per IT Act. Self-generated assets, you have to take the cost as nil. For capital asset on which deduction is allowed under section 35 AD also, you have to take nil. For other assets, you have to take the book value. And one more thing, revaluation have to be always ignored. Just by heart these points. This consideration also. In case if they have given any MCQ, you can aram se solve this question also. This topic also you just have to solve. Guys, whatever the revisionary which I have made, this is very comprehensive. I have tried to cover all the things. Wherein required, I have taken number of examples as well. So what you have to do is watch this marathon completely. And while completing the respective concept, I recommend you to check and solve the problems also whichever is there in your workbook. Whether you are following mine or whether you are following any other faculty for that matter. Aram say after completion of this concept, you just have to quickly open the workbook and you have to solve the questions. I hope the point is clear. So that's it, guys. We have finally completed the most awaited, most interesting capital gains ka chapter we have did. Okay, all the best, and I will be coming up with next chapters also very, very soon. Thank you so much and all the best.